From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
President Trump says his economic plans are already working, even as stocks tumble again. Welcome to the fastest show in politics on this day that markets throw another tantrum over tariffs. I'm Joe Matthew alongside Kaylee Lines in Washington. Thank you for being with us on the Friday edition of Balance of Power. Kaylee, much like we were talking yesterday, the S&P 500 on track to have its worst week since the depths of COVID.
Yeah, the worst two-day sell-off potentially since March of 2020 when those lockdowns were at their height. That is, of course, after China decided to retaliate against U.S. tariffs by placing a 34% levy on all U.S. imports into that country. And President Trump suggesting that he's not going to change his policies, that they are here to stay. Meantime, the Fed isn't signaling a change to policy anytime soon, as Chairman Powell reiterates that while tariffs may pose, in his words, a persistent inflationary risk, the Fed is still in no rush.
In no hurry to cut interest rates here, so we've got a bit of a quandary. It was interesting. We carried his remarks live right before the noon hour, Kaylee, and that's when markets really started to reach lower. Jay Powell not making anybody feel better on what is jobs day. Payrolls came in hotter than expected. In any other world, this would be our top story today.
Yeah, and we're going to have more on the payrolls, but everything else that is driving markets today from the White House. Just moments from now, we'll be joined by the chair of the Council of Economic Advisors, Stephen Myron. But first, we do want to check in on the market activity as we close out the trading week here on a sour note. Charlie Pellet has a look from New York. Hey, Charlie.
And I thank you very much, Kaylee and Joe. We are just about lows of the session on this Friday, on track for another losing week. It'll be the sixth week of losses in the last seven. The Dow, the S&P, NASDAQ, all plunging again, I might add, right to the numbers, with the S&P down 4.7% now, down another 255 points. The S&P at 5140. The Dow down 1,630 points now, lower by 4%. The NASDAQ Composite Index down 800 now, down 4.8%. The 10-year at 3.94%, with the 2-year currently yielding 3.61%. Spot gold moving lower by $85 the ounce, down 2.7%. The precious metal now at $30.30 the ounce. West Texas Intermediate crude down 7.5%, 61.90 on WTI. Bitcoin higher right now. We have got Bitcoin up by 1.2%, 83,302 on Bitcoin. Briefly, Klarna, StubHub pausing their IPO plans after Trump tariffs roil markets. Balance of Power continues. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet, thank you so much. We'll get back with Charlie in a short time as we're keeping constant checks on Wall Street for you today. This is a difficult period of time for financial markets and a perfect time for us to be speaking with President Trump's economic advisor in the Council of Economic Advisors, where he works as chairman. Stephen Myron joins from the North Lawn of the White House on Jobs Day, as a matter of fact. Mr. Chairman, welcome back to Bloomberg TV and radio. It's great to see you. As we mentioned earlier, this jobs report would be our lead story on any other day, with payrolls blowing the doors off. But after everything we have seen in the financial markets, and knowing that President Trump has now put forth his plans for tariffs taking effect tomorrow and next week, are these data already old?
No, I don't think the data are already old. I mean, look, you know, we're very pleased with the jobs report that we got. The economy created 228,000 jobs in March. That's roughly twice the amount of jobs that it created in either January or February. In fact, it was such a good month that it was, in fact, the fourth best month in the last 2 years for job creation. That's pretty spectacular. And, you know, in spite of some headwinds that folks thought would be material headwinds, the president has acted very swiftly and forcefully to close the border and to prevent the surge of, and to stem the surge of illegal aliens coming into this country. And lots of folks said, oh, that'll be bad for job growth, right? That'll be bad for job creation. Well, this report proves that that might not necessarily be the case. And so what the report shows is the economy is continuing to grow in spite of the president's variety of policies, and it's a good sign.
Well, but this report, Mr. Chairman, is by nature backward-looking. I think the concern financial markets have today is about the forward-looking picture and what the economy is actually going to look like in light of these severe tariffs that are being implemented starting tomorrow, the layoffs of federal workers that the Department of Government Efficiency is pursuing. How can you guarantee the labor market will hold up in the face of those challenges?
Yeah, thanks. So look, the president acted with historic scope and speed to address what was a decades-long festering problem that had been eroding our competitiveness and eroding our prosperity and eroding our economy. And so, of course, there's going to be some market volatility on the back of that. Of course, there's going to be some adjustments on the back of that. But on the end of it, things are going to be materially better. And I'll tell you why. Not only will the tariffs incent reindustrialization in America and companies coming back to build in America, but there's also two other legs to the stool that are of significant importance. There's the deregulatory agenda, and then there's the tax agenda. And both of those are profoundly stimulative for the economy. And one point that I like to make is that imports are only 14% of the economy. The other 86% of the economy is affected by the entirety of the agenda. And so that's tax and regulation, and both of those are going to be very important.
I'd like to ask you, Stephen, about the comments that we heard from Jay Powell a bit earlier today. The Fed chair had this to say about the potential impact of President Trump's tariff regime. Listen.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
Stephen, our Edward Harrison writes that unless the labor market data deteriorate precipitously, the bond market is going to have to reverse some of its post-Liberation Day rally, taking stocks down further in the process. The jobs report today is bad news for stocks and bonds, he says, because we're not going to see lower interest rates anytime soon. And the chairman today suggesting that he is in no hurry, even as President Trump puts on Truth Social that this would be the perfect time to cut interest rates. What is your message to investors when it comes to rates here against the backdrop of tariffs?
Sure. So first, let me be clear that, I'm not going to tell the Fed what to do, but I will point out that we lived an experience of tariffs in 2018, 2019 during the president's first term, and there was zero macroeconomic evidence whatsoever that tariffs had any material inflationary impact. In fact, the Fed wound up cutting rates on that event. So I think it's important to understand.
But we're talking a different scope and scale now, Mr. Chairman. The tariffs from the last administration are nothing like what we're seeing now.
Yeah, the president has acted with historic scope and speed. I agree with that. But we also have to appreciate what's going to be happening on the tax and regulatory front. And I think that one of the most powerful things for determining the supply side of the economy is the regulatory environment. If prices are high and increasing because there's not enough stuff, the best way to address that is to make more stuff. That means getting government out of the way, letting firms invest, letting firms build, letting firms produce. And if you make more stuff, you can address not only inflationary pressures, but actually bring some prices down. And I think that that's powerful and arguably much more powerful than any effects of tariffs.
But what is the actual lag time between seeing a lesser regulatory burden, seeing tariffs that maybe would incentivize U.S. manufacturing to invest in that capacity, the lag time between the decision to do that and the actual capacity coming online and whatever employment or what have you will come with it? This isn't going to be an automatic thing, right, Mr. Chairman?
Yeah, thanks. So that's a great point, which is that, the regulatory process and taking away those regulations is a legal process, and that takes some time. And the president has made historic progress in the first 2 months peeling back regulations, but there's still so much work to do. And it'll take some time for us to get that through. And so that's, maybe this is part of why there's market volatility, because implementing the totality of our plans will take some time. Congress is working on the tax package as we speak. It will take some time to pass it. It will take some time to implement it.
We're hearing a lot of concerns about a recession. Money managers are pointing their trades toward a recessionary environment, and JP Morgan today increased odds for its recession forecast to 60%, up from 40%. Stephen, what are yours?
I'm not a professional forecaster, so I don't necessarily have odds. But what I will say is what I said a moment ago, which is that imports are only 14% of the economy. So you really have to think of, really, really huge, really enormous changes sort of shaking through those things to get to the place where you think a recession is likely as a result of something like this. And as I said before, I think that the president's pro-growth policies on the regulatory front, providing further tax relief to American families, extending the tax relief of his 2017 Tax Cuts and Jobs Act, I think all of that is profoundly supportive of growth. And I think there's maybe a little bit too much focus on risks from what's going on right now, and not enough focus on the pro-growth policies that are
well, we're
being
certainly
implemented
focused
now in the
on Wall
pipeline.
Street. I understood. I don't mean to interrupt, sir, but there's a great worry about the negative wealth effect. This market is in free fall right now. We could continue this next week unless there is some change here in the news cycle as we hear about additional retaliatory tariffs. At what point does this drag consumer spending with it?
Yeah, so look, you're right. There can be some wealth effects. There will be some wealth effects. There will be, there will be ramifications of that stuff. But like I said before, we have to balance that out against the totality of other stuff going on in the policy agenda, the totality of the other strong drivers of economic growth. One point that I've made a lot is that the Biden administration's last 2 years, almost 3/4 of jobs that were created were in government and government-adjacent sectors, and that's profoundly unsustainable to have the government gravy train driving the economy. In the March jobs report, that number came down from almost 75 in the last 2 years of the Biden administration to just about 40, right? So that's a very material decline, and this is part of reconfiguring the economy from a government-driven growth engine to a sustainable, durable private sector growth engine, and this is going to continue.
As we consider the growth outlook, keeping in mind that you did just tell us, Mr. Chairman, that some of this will take time to materialize in terms of the stimulative efforts of this administration, whether legislatively or otherwise, if the Federal Reserve were to decide that it has to prioritize inflation, and if inflation persists and they don't want to cut rates, but we do see a material downward shift in growth or in the labor market, is there a lever that the White House is going to be able to pull more immediately to try to offset those effects if the Fed can't do both at the same time?
Yeah. So again, I'd point you to the forthcoming tax legislation that's being worked out on the Hill, and I think that will allow the president to provide profound tax relief that will be excellent for American families, American workers, American firms.
Well, going forward, Mr. Chairman, I wonder what's going to happen in terms of messaging to this market. Are we going to hear more from the administration, from the President of the United States, from yourself, when it comes to the dollar, when it comes to investing in the stock market in the United States? I know that frequently the refrain is we're seeing companies invest in America, but how about in our financial markets where we've seen, I believe, a half dozen IPOs today delayed, some of them pretty large. We're hearing from some major firms planning to go public as soon as next week that are putting those plans on the shelf. What does the administration tell them?
Yeah, so I'm not gonna comment on specific companies and IPOs, but I will say what I said before, which is that of course there's going to be some market volatility on the back of the president's historic actions. But I also want to redirect you again to what we can do. And so, the tariffs are designed to redress the emergency of trade deficits, but there is a nice side effect, which is they raise a lot of revenue. And if you use that revenue not only to extend the historic tax cuts from 2017, but to provide further tax relief for American families while deregulating the economy and making it easier to invest, build, hire in America, you have the recipe to create an economic boom, wherein America is much more competitive because of the tariffs. It's much more competitive because lower taxes, households, firms, workers keep more of the money they earn every week, and they spend more of it, they save more of it, they invest more of it, and you get the government out of the way so they can build and invest and make factories. And that is the recipe for an economic boom. And if we keep at it, we can create a really great environment for firms to invest and hire, and that will, in the long run, drive the financial markets.
The other thing that tariffs, you would think, at least traditional economic theory would tell you, would lead to is a stronger dollar, and yet that's not what we've seen in the immediate aftermath of the announcement of these, Mr. Chairman. How concerned are you about a period of sustained dollar weakness?
Thanks. So, look, my view, as I've expressed before, is that classic economic analysis would say that the burden of any economic policy, whether it's a tax, a subsidy, no matter what it is, falls on what economists would call the more inelastic party, but I think is easier for other folks to understand as the more inflexible party. And the example that I keep giving is if you're looking to buy a house and the town that you're looking in raises its property tax rates and you're flexible, you can just look at the next town over. You can change your behavior to avoid the burden of the tax. The person who's selling the tax can't move his house across town lines, so he's got to eat the property tax and lower his selling price. And in that way, the burden of the tax fell on the person who couldn't move his house. And the same is going to be true in international trade. American consumers are flexible. We can make stuff here at home. We can change the countries from which we import. We can stop importing from a country with a high tariff rate and start importing from a country with a low tariff rate that treats us better, that is a better trading partner with us. And that ability to change our consumption patterns, whether to move it home into home production or among different countries, makes us more flexible. By contrast, installed factories in China, they've already spent the capital, the factories are stuck on the ground, the workforce is already trained to build products aimed squarely at the U.S. consumer markets. Those cannot move. So in the long run, other countries, the tariff countries, will end up bearing the burden of the tax, of the tariff. Now, there's a couple ways that can happen. In 2018, 2019, it happened through the currency, but it need not happen that way again. It could happen that way. It doesn't necessarily have to happen that way. There are plenty of other ways they can end up bearing the burden of the tax. It could happen through reduced selling prices.
All right, Mr. Chairman, we appreciate you joining us here on Bloomberg TV and radio. Stephen Myron, the chair of the Council of Economic Advisors at the White House, thank you so much for joining us on this Jobs Day. But of course, while we did get a strong payrolls report, we are not seeing strength, at least in risk assets today. We're right around the session lows on the major equity benchmarks. The S&P now down 5.2%, the NASDAQ 100 down 5.4%. We want to get more on these markets now with Bloomberg's Romaine Bostick, who is joining us from New York. Romaine, I got to say, I'm kind of feeling flashbacks to March 2020 here.
Yeah, not just around session lows. We are at its session lows. And just to put this into perspective, Kaylee, 500 stocks roughly in the S&P 500. Only 14 of those stocks right now are in the green. We're headed towards what is going to be more or less an unprecedented day. The superlatives pretty much stack up like this. More or less, we're having the worst day since at least 2022. For certain sectors, the worst day since the onset of the pandemic. And if you take the pandemic out of the equation as sort of a one-off outlier, this is quite frankly shaping up to be one of the worst days since the late 1970s. This is a market that is completely shut down, not just in equities, Kaylee. We've had several IPOs that have been put on pause. That includes names like Klarna, StubHub, Chime. Several deals that were in the works have also been paused. Not a single corporation has been brave enough to try to sell new debt today or yesterday. And right now, you have this sense of paralysis amongst economists, despite the comments that we just heard from the CEA chair just a few minutes ago. Most economists say right now they have no idea how to chart a path forward.
You know, you talk about the fundamentals in this market, Romaine, kind of falling apart. What about the technicals? We have so many broken charts. Even if the news improved, would that help to lift stocks from where they are now?
Well, keep in mind, you know, a couple days ago, Joe, the support line on the S&P 500 was supposed to be 5,500. Then when we got broke below that, people said 5,400. Right now we're trading right around the 5,100 level. That is the low of the day, 5,104 and change. And so whatever support levels were there, they've been broken. Even when you look at other sort of lines, such as moving averages, Joe, the fact that the S&P 500 right now is in oversold condition, that's where that 14-day RSI dips below 30. Traditionally, these are all lines in the sand where typically you'll start to see a rebound in stocks. The dip buyers come in. You're just not seeing it there right now. The technicals are working against them. The fundamentals, potentially, because of economic conditions, are working against them. So the big question now, right now, Joe, is if you do want to stay in this market, what actually do you buy? What are you brave enough to buy?
Not the truth. The analysts aren't exactly telling us. Romaine, it's great to see you. It's been great having Romaine Bostick with us.
I have a feeling we're going to talk again
these
soon,
very bumpy
Joe.
days this week. I think that might happen. What are you doing at 5? With me in Washington, Kaylee Lines, of course, here on the fastest show in politics, as we try to bridge here what's happening in Washington with what is happening on Wall Street. You can't remove the two here, Kaylee, as we reach ever lower, having heard from not only the president, but the Fed chair.
Yeah, the Fed chair signaling they're still not in a rush to cut rates, though it is warning of the inflationary risks of these tariffs. And it's interesting to note, after we heard from the chairman, you saw even more buying coming into the bond market. Maybe that's the only thing anyone wants to buy. The 10-year yield right now down 11 basis points at 392. This is Bloomberg.
1:21 on Wall Street. We do check markets all day long here at Bloomberg. We are just about at the lows of the Friday session, on track for another losing week with the Dow, the S&P, NASDAQ deeply in the red. S&P on pace for its worst two-day rout since March of 2020. Right to the numbers with the S&P 500 index now down by 5.2%, down 279 points. Dow Industrials down 1,850 points now. That is a decline of 4.6%, while NASDAQ is down 863 points for the NASDAQ Composite Index, a drop there of 5.2%. Broad-based selling, Russell 2000 index of small cap shares down 5.6%. The 10-year now at 3.93%, with the 2-year 3.60%. Gold is down $92 the ounce. Gold plunging 3% now to $3,022 the ounce. West Texas Intermediate crude is down 7.9%, $61.68 a barrel, and Bitcoin higher by 1.2%, 83,289. Wall Street banks are enduring another sharp sell-off. JP Morgan Chase, which reports earnings a week from today, down now by 6.8%. Goldman Sachs down 7.6%. Morgan Stanley down 7.8%. And Citigroup lower now by 8%. Among regional bank names, First Horizon down 8%, and shares of Western Alliance Bancorp, they're down by 8.2%. Recapping, S&P down 5.1%. Balance of power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. Keeping an eye on financial markets, which, as Charlie just told you, have had a rough couple of days. In fact, for equities, the worst two-day stretch since March of 2020 is what we're heading for right now, with a bid coming into the bond market as investors are looking for safety somewhere. Keeping in mind, they all just heard from the chairman of the Fed, while there may be some persistent inflationary risk due to the tariff policies announced by President Trump this week, the Fed is still not in any rush to lower interest rates, despite perhaps, Joe, the desire of President Trump for them to do so. He actually said on True Social today it would be the perfect time.
Right,
for Chairman
today would have been right before that meeting, maybe. In fact, that was timed to coincide with his remarks. It wasn't until Jay Powell started talking that we saw these new lows on Wall Street, because now the fear is, of course, we're not going to see lower interest rates anytime soon. Fascinating conversation with Stephen Myron at the White House coming off the jobs data today. He continued to point us to Trump tax cuts. They're just getting the ball rolling on that on Capitol Hill. In fact, we're going to have some votoramas over the weekend that could be pretty interesting. We'll be talking about that likely on Monday. But what a treat to have the chairman of the House Financial Services Committee with us. We remember when he was just a congressman. We remember when he was just a community banker. But that's why this is an important conversation, because of the unique perspective that French Hill brings to us from Arkansas. It's great to see you. It's been too long. Thanks for coming in.
It's been great to be back with both of you. Thank you.
So what do you think of this? I know you're sensitive to the markets. You don't like what you're seeing here on Wall Street, I'm sure. The line from Stephen Myron was, just hang on. We're working on extending the Trump tax cuts along with a number of other tax points of tax relief that will help to make this better. Does one offset the other?
Well, I think it's such an important question, and I'm concerned that we cover up the strategy of right-sizing regulation, tailoring regulations, getting balance back in the regulatory system, which President Trump was so successful on in his first term. We want to do that in this term. And as you noted, the Senate will be voting on the House Budget Reconciliation Bill this weekend that'll lead and unlock the ability to block a major tax increase for business and for American households. Those are big, certain issues that I think we can get done. I believe strongly in them. And I don't want to see a tariff strategy, offset that, which is why I believe in trade diplomacy. I think President Trump's right to engage in trade diplomacy, but I believe sincerely that you should target sectors in a very isolated way and achieve results, and do the same thing in reciprocity with countries you think are bad actors that are not open to American products. And then finally, as it relates to Canada and Mexico, I really think the president should advance the negotiations on the USMCA reauthorization of that treaty, that trade arrangement, and let's make some changes. Let's make sure that Chinese component parts are not dumped into Mexico or Canada and go into the supply chain.
So why not have Congress take the lead on that? It is your Article 1 authority to do so, and yet this is being driven out of the White House, not by your chamber or by the Senate. Does that need to change to calibrate this policy in a better way for the economy?
Another good question. Since the late 1920s, Congress had been in the tariff setting business, and they were so frustrated by it and so bad at it that they delegated it to the executive branch under trade promotion authority. But I think Article 1's job there is to make sure we try to get it right, work with the administration to get it right in the Senate's case, ratifying treaties where necessary. So that's what we need to do. Trade promotion authority, which was reauthorized in President Trump's first term, has expired. President Biden did nothing about it. I think that would be a good step for the Congress to consider reauthorizing that.
What does the banker inside you, never mind the chairman of financial services, think about when you hear companies say, why are we being unfairly targeted? All we have done is play by the rules. We came out of China, we went to Mexico, we went to Vietnam, now we're being penalized for that. Aren't they correct in making that point?
Well, I think it speaks to the uncertainty nature of this. I hear it from my own constituents at home who are manufacturers who make something, but some of the component parts and what they make comes from outside the U.S. They're concerned about the cost. Will their product be competitive? And the same is true for Arkansas, a big agricultural state. Right. Much of what we produce goes to Canada or Mexico. So these are important issues, and that's why I think the strategy has to be right. Using trade diplomacy to open new markets, using trade diplomacy to lower rates in certain product categories, like auto in the European Union, for example, and using trade diplomacy to punish bad actors. Those are all important elements of it, and I think that gives some certainty. When you use an across-the-board approach, you get that uncertainty that my constituents are reflecting. So I hope we can work on clarifying that in the weeks ahead.
Well, and in the weeks and months ahead, the White House, as Joe mentioned earlier and you were alluding to, the White House is pushing toward tax cuts that have to happen at some point if the TCJA is not going to expire. I do wonder, though, the argument around that tax package in 2017 was it was going to juice the economy. It was going to put more money into people's wallets. It was going to give businesses more money to make capital investments. Is it going to have the same effect this time around, though, if it's just an extension of what already exists and those people and businesses may be feeling a bit more of a pinch in terms of the margin they actually have to work with to spend that additional capital?
Well, the expensing has been being phased out, and so the renewal of that, I think, will spur capital investment. The R&D tax credit, the same. It will spur new investment. You're right, at the corporate marginal rate or at the household marginal rate, people would just feel relief. Good. I mean, I can count on that going forward. So I think it will unlock some activity in the economy, and it will produce faster economic growth, even if the marginal rates don't change dramatically.
There was a time when revenue from tariffs was pitched as a way to help pay for extending or making permanent the Trump tax cuts. Is that part of the conversation any longer, or are the tax cuts going to be extended in lieu of the tariffs?
Well, in our discussions in the House, I can't speak for the government at large, but in our discussions with our colleagues in the House, we've been thinking about the importance of extending the President Trump's tax cuts, cutting spending, trying to right-size government so that we don't have $2 trillion deficits. This is a major goal of our House Budget Committee, and we're not counting on tariff revenue, because tariff revenue is very difficult to predict. You have countervailing duties. You have people will change their buying patterns. So to automatically assume that you can count on that, I think is not significant or smart. So we have not per se counted on that, and OMB does not count tariff revenue in their scoring. So as we get closer to that final vote, we'll look and see where this Trump tariff plan settles, and that may give us some indication. But in the meantime, we're working independent of that, I'd say.
We were just listening from our colleague Charlie Pellet looking at the markets, specifically at bank stocks, some of the big investment banks that were counting on a revival in companies coming to the public markets and re-engaging in M&A activity. This gets back to the kind of regulatory burden you were referring to earlier. Are you concerned that some of this wider economic impact, companies now deciding perhaps is not the best time to enter the public markets, that regulatory burden being eased maybe for not if they can't actually take advantage of it?
Right. Well, certainly, I hope that the competition focus of a Trump FTC, Federal Trade Commission, is open towards business entrepreneurship, business combination, where it produces more competition. And I would hope that we are able, in our regulatory focus on capital formation, to encourage more public companies because we lower the cost quarterly of being public. That's a goal of mine as chairman of the committee. But anytime you have wide market uncertainty in equity prices, you're going to have people pull back from a scheduled IPO because they need market certainty.
Right.
And so I hope this settles down soon because I know there's a lot of interest in advancing that equity market through the IPOs.
We've been talking, Mr. Chairman, for the better part of 10 minutes, and somehow Kayleigh Lyons has not asked you about crypto.
I was saving it for last.
About the Stable Act. Well, my gosh, we only have a couple of minutes left here.
Yeah.
You had an important week when it comes to this. It's something that gets lost in a very noisy news cycle, but this is important, something you've been pursuing for months and months.
This is a real effort for the past 4 years, really, working with former Chairman Patrick McHenry, Ranking Member Maxine Waters, to craft a dollar-backed stable coin under U.S. law inside the largest capital market, the most important economic country in the world, that we would have our own dollar-backed stable coin where we could have a tokenized dollar payment on a blockchain. We had a successful markup, bipartisan result, and this is a companion to just a few weeks ago, Bill Hagerty, Cynthia Lummis, Tim Scott, Diane Gillibrand got a Senate dollar-backed stablecoin bill out of the Senate Banking Committee. This is the first time we're demonstrating, I think, to the markets that we can make progress on this. I think we can get that passed this year, and I think we can also get the market structure bill passed. You've got to link them because a dollar-backed stablecoin, but without market structure, how would you custody it? How would you exchange it? How would it be used? So they're important that we try to keep them working together. President Trump's asked us to complete that work by the August recess.
Okay, so in terms of sequencing, will we see a full floor vote on the stablecoin legislation before market structure efforts begin, or is that already underway?
I think House and Senate leadership have the best strategy under discussion. Tim Scott, Bill Hagerty, Cynthia Lummis, they're outstanding leaders. They know this issue well, and we know it well in the House, so we're going to craft the best legislative strategy.
All right. How different will it be to Fit 21?
We have our first hearing next week. Brian Stile of Wisconsin will convene his first market structure hearing in the House. We're excited about that, and we hope to get that text ready in the next few weeks.
We need a Stile Hill panel.
Yes.
Oh, yes.
When the time comes. Can we do that?
We can do it.
All right.
All right, well, we'll look forward to it. And we were
Great to be
so
with you.
excited to
Thanks
have
for
you
the
in
invitation.
studio
Thank you,
today,
sir.
Mr. Chairman. That is the chair of the House Financial Services Committee, Congressman French Hill of Arkansas, here with us on Bloomberg TV and radio. Interestingly, crypto won bright spot today, I would note,
right?
Joe. If you're looking for haven, maybe you're finding it in treasuries, but maybe a little bit of marginal buying coming into Bitcoin as well. Can't say the same for other risk assets, though, as we're just off session lows, but still down about 5 percentage points on the S&P 500 and NASDAQ 100.
A little bit of a bid under Bitcoin, but this is a risk-off market. My goodness, we're still trading near the lows of the session, and we'll have a lot more coming up here on the fastest show in politics. You can't remove Washington from Wall Street. That's why we're here on Bloomberg TV and radio alongside Kayleigh Lyons. I'm Joe Matthew. Thanks again to Chairman French Hill. We'll have much more ahead on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg, and we begin with the developing story headlines from the Bloomberg Professional Service. President Trump says he has decided to extend the deadline for Chinese firm ByteDance to divest TikTok's U.S. operations and give his administration more time to finalize a plan to keep the popular app up and running in the United States. Stocks are off session lows, but still a down day in which we have got the S&P 500 index plunging by 4.5%. The Dow, the S&P, NASDAQ all deeply in the red. Stocks are plummeting, with the Dow now down by 1,591 points, down 3.9%. NASDAQ is lower by 4.6%, down 755 points, while the Russell 2000 index is down 4.8%. Again, keeping it all in context, the S&P right now down by 4.5%. 10-year yield at 3.97%, with the 2-year 3.64%. Spot gold down $87 the ounce to $3,027, a drop there of 2.8%. And West Texas Intermediate crude plunging 7.5%. WTI 61.93 a barrel. Oil at a 4-year low, taking oil stocks, oil majors with it. Case in point, ExxonMobil down 5.5%. BP now down by 9%. The ADR is down 9%, and Chevron lower by 6.3%. And again, repeating the headline from the Bloomberg Professional Service, President Trump extending the TikTok deadline for 75 days. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Haley Lyons.
Okay, Charlie, slinging the headlines once again today for us from World Headquarters in New York. We'll be back to Charlie shortly for an update on the markets here. So a new date to circle on the calendar, Kaylee, 75 days. Not a big shock. Obviously, we were creeping up on a deadline in the next 24 hours without a deal in place. It's unclear, though, whether still, I ask, would China sign off on such a deal? Because that would be required for this to happen, and they just put retaliatory tariffs on us today.
Yeah, well, and the president does make reference to that in his post on True Social. He says, we hope to continue working in good faith with China, who I understand are not very happy about our reciprocal tariffs. He goes on to say, this proves that tariffs are the most powerful economic tool and very important to our national security. Keeping in mind, the president has floated multiple times over the last week, lessening the tariff burden on China if it means they agree to a TikTok divestiture.
Tariffs are the most powerful economic tool, though, I guess, in generating reciprocal tariffs and in sending the stock market lower, because that is what they have achieved today. Commentary from Jay Powell seemed to only make it worse.
Yeah, well, and we want to get some more commentary of our own here on this program as we bridge Wall Street and Washington and turn to Democratic Congressman Glenn Ivey of Maryland, who is here with us in our Washington, D.C. studio. We have much we want to discuss with you, sir, and welcome back to Bloomberg TV and Radio. First, though, as I know you did vote for the legislation that included this divest or ban law for TikTok, another 75-day extension. Does this go against the nature of what that law was actually supposed to achieve?
Yeah, it does. And if you look at what they did over the previous extension that the president gave them, as far as seeking a business solution, I didn't see really any effort to do that. So extending them 75 more days to do what is the question that I have. If they're not really going to be trying to figure out a way to resolve this from a business perspective, then they're just playing a stall game, and the president's falling for it. So I hope he'll get out of the way of that. I don't think he really has the statutory authority to do what he's doing here, but you know, we'll see how it plays out.
Well, in the time that you were preparing to vote on that bill, the bipartisan case was established that this was a national security threat. Has any of that changed?
I don't think so. And if you look at the ads that they run, which never mention ByteDance, but, you know, float all these nice people in middle America who are making money using TikTok, and we all know that that's the case. But the fact that they're continuing to push it and act like this is only about TikTok and has nothing to do with ByteDance, I think indicates how, you know, the potential for misinformation and disinformation can be spread through this. And they're doing that very aggressively and apparently pretty well.
Well, so there's the national security element of TikTok. I guess there's also the national security element of something that the president is now tying to TikTok, which is his tariff policy, maybe using it as leverage in this particular instance. But overall, as we consider the tariff regime that was announced by the administration this week, I'm wondering what you're hearing behind the scenes from your colleagues in the House, not just from your fellow Democrats who are obviously making their feelings well known, but from Republicans. Are they saying things to you in private that they're not willing to in public about this?
Yeah, but I mean, you're starting to actually see them say things in public too.
Sure.
I mean, the loud screams you hear in the background are not just Democrats and average Americans. They're Republicans who see this as maybe one of the biggest political blunders that I can recall in recent memory. This is a total unforced error. You know, the economy was moving in a relatively good direction. Whether you like what Biden did or not, when he left, you know, the U.S. economy was pretty much the envy of the Western world. Trump inherited a good economy. The jobs report that just came out indicates that things were moving in the right direction, probably. All he had to do is kind of not get in the way, and this is driving the truck off the cliff. I've never imagined that he would do this. And then to do across-the-board tariffs on every product for almost every country at the same time, and then act like you're going to negotiate with all of these at the same. It's ridiculous. I'm not sure what he was thinking when he did this, but I don't know what the exit ramp is. I don't really see one. He's mad at Powell for not giving him one, but Powell did, I think, what people were expecting the Fed to do under these circumstances.
Well, the impact locally for you is very real. It's not just the tariffs here, and that's obviously hitting people across the board. The market reaction hits people across the board. The DOGE cuts, though, hit you directly with federal workers who live in your district who are being shown the door. Then you add what took place with some of the budget cutting. I know that the House has yet to reverse the budget cuts for the District of Columbia, but people are starting to sit back around here. We're on global television and radio right now. People are listening to you as well on 99.1 FM in Washington saying, hey, wait a minute. The Washington, D.C. area, the DMV, used to be recession-proof because of the fact that the federal government was here, or at least there was a shock absorber, Congressman. Does that exist anymore?
Maybe not. You know, what he's done in the attack on federal employees is been extremely damaging. I mean, he's thrown people's lives up in the air, and I know there's a lot of people who don't have sympathy for so-called bureaucrats, but people are now starting to feel the impact of the services that they're not getting because these people have been fired. And some of these things are going to be very long-reaching and far-reaching. So, you know, cutting the clinical trials for Alzheimer's, cancer, you know, Parkinson's. My father died from Alzheimer's and Parkinson's, a combination of those. So to see the clinical trials derailed just kind of, you know, by happenstance is astonishing. And then the impact on, you know, people who are seeking their PhDs or starting their research careers. We're going to have IonQ on here in a minute, but, you know, China's throwing money at AI, quantum computing, and the like. They're trying to grow as many of these scientists and engineers as possible. Trump's cutting the money for that, and that's just scratching the surface. I mean, you know, we could go through, you know, the impact Medicaid cuts, impact on elementary schools, you know, the impact on local hospitals in rural and urban areas. I mean, it's astonishing, it's far-reaching, it's extremely damaging. And I think when you combine that with the tariffs that he's put in place now, you're certainly looking at a recession in the Washington metropolitan area, but I think you're probably looking at one nationally as well.
You mentioned IonQ. This is a quantum computing company that you introduced us to some months back, and you were joined on the air here by the then CEO. Niccolo de Masi, the president and CEO of IonQ, now in charge of the company, joins us now as part of our conversation. Niccolo, we want to add your voice to what we're talking about here and welcome you to the conversation. With a lot of questions we have about quantum computing and the charge that you have at IonQ, been pretty remarkable hearing you called out by Jensen Huang recently, but there are great concerns now about a company like yours seeing innovation stifled and having more difficulty accessing capital because of what's happening in the financial markets driven by the tariffs. What do you think?
Well, first of all, I want to thank the congressman for including me in this, and thank the congressman for all the support that he's given to IonQ. You know, we were born on the University of Maryland campus 30 years ago with Dr. Chris Monroe, and we, of course, do a lot with the university, the ecosystem, with the DMV, and, of course, with all the associated, you know, ecosystem of agencies in the area. You mentioned China. I mean, absolutely, they are investing, you know, probably $15 billion officially in quantum computing, and I bet it's more unofficially given how things work over there. And I would concur that quantum computing and quantum networking, which is the other half of our business, so it's safe making and safe breaking, really are not just the paramount for the national security of our country, but they're fundamental to the economic growth prospects of our economy. And so, we work, of course, across the aisle. We work with the administration, every administration, and it has been a bipartisan issue, which we're grateful for. I mean, our machines are made in America. Our quantum networking also is rolling out in America in places like Tennessee, for example. And ultimately, we believe that tariffs will be a far bigger issue for companies that are structured differently than INQ. But nevertheless, we look forward to continued support in the state and, of course, federally as we continue to grow this vital technology for our country.
But what about the notion that, at least in terms of China's retaliation against the U.S. policy announced this week, it's not just tariff measures, but also restricting access to critical minerals? Is that something, given the role that those play in quantum computing, that could affect your company?
Well, it can affect some companies in the quantum computing space. Fortunately, it doesn't impact INQ. Just yesterday, DARPA, in fact, awarded us the first stage of their own journey towards building, let's call it encryption cracking and encryption protection. So, the basis of modern civilization relies on secure communications. Battlefield of the future relies on Battlefield of today relies on secure communications. And ultimately, quantum computing helps you both optimize that, and quantum networking helps you ensure that e-commerce, banking, you name it, as we know it today, goes on, perpetually, right? So this is an issue that, we fortunately are well funded. Our stock, of course, has not had a great day today, but our stock has had a better day than everybody else who's exposed, fully to these measures for sure. We're heartened by the fact that we've got such strong support in Maryland and many other states, as well as in the federal government. They all recognize the criticality of information, the criticality of optimization, the criticality of computing. Jensen Huang will see us as a competitor someday, but at the moment, we're just expanding the compute market with quantum processing units. And our technology that you can see behind me is actually what's called an ion trap quantum computer. And we don't have to import any minerals for this, fortunately.
This is really impressive stuff, Congressman, which is why, of course, you introduced us to IonQ. Knowing that they're working at the University of Maryland, how concerned are you about federal grants being withdrawn or being challenged by this administration and testing the innovation of a company like this?
It's extremely problematic, and we've got other entities. Johns Hopkins is in Baltimore. They're outside of my district, but they just had to lay off 2,000 employees based on what the administration had done as far as cuts. And if we're looking at growing the field of scientists and engineers that are coming up out of college, out of graduate school, and getting into these professions now, he's wiping out the grants that they use to do their research. He's wiping out the indirect cost payments so that allow these universities to do it. He's wiping out the grants and, in some instances, contracts to go to federal agencies like NASA, where the research is done. So we've got this crop coming up with no place to go here in the United States. By contrast with China, they're not only are they, growing more of these people faster, but they're throwing dollars, or the Chinese equivalent of that, into funding it so they can expand it quickly. We're still in the lead, but the president's walking us off the field right now, and when we should be competing and maintaining the lead that we have.
Well, Nicola, we only have a minute left, but can the private sector make up for anything or the lack, I guess, of investment or a pullback in investment from the public sector?
We're doing our best, Congressman, for sure. We're trying to grow the job market, our quantum center that we have in partnership with, of course, Maryland and UMD, and we're very much part of, and I think a central tenet of the quantum initiative and expansion of our headquarters to create those research opportunities, create companies and incubation and entrepreneurship around our technology. So, we're well capitalized, and we'll do all we can every day. Needless to say, though, we rely on partnerships with Maryland, the university, the federal government, to ensure that our technology makes it into the commercial sector, the public sector, onto the battlefield into drug discovery, into, let's just call it aerospace of the future and optimization opportunities of the future every day of the week. So let's hope that this is a moment in time and that it's all up from here for both of us.
All right, Niccolo de Masi, President and CEO of IonQ, joined by Democratic Congressman Glenn Ivey of Maryland, here with us on Balance of Power today. Thank you both so much for joining us. We'll be back for more in the late edition of Balance of Power coming up at 5 p.m. Eastern Time.
Where else are you going to hear a conversation like that but on Bloomberg TV and radio?
is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Not sure if I should say a very good afternoon, everyone.
I mean, it depends on if you're short or long.
That's a really good point, as we like to remind everybody, two sides to the trade, but it does really feel like those who are trying to make some gains in this market, it's been a rough 2 days. So a good afternoon, everyone. Carol Master along with Tim Stanovic live here at Bloomberg headquarters in New York City. Check this out, though. Klarna, StubHub, Chime, right? Just 3 that are canceling, Tim, their IPOs.
I thought this was supposed to be the year of deals, the year of IPOs. There's more, though. This as stocks continue to plummet with the S&P 500 on pace for its worst 2-day rout going all the way back to March of 2020. Yes, you remember what happened then. It was the onset of the COVID pandemic. Market's certainly front and center for us.
Yeah, pretty dark that time. So we're going to try and kind of get a good picture of what we're hearing in the C-suite and what folks are saying about this macro environment. And yeah, all right, we did get a jobs report this morning. We're doing okay. In fact, we're doing pretty well when it comes to the U.S. labor market. But what we really, really care about is what Jay Powell had to say about tariffs today.
Also, we're looking at the bond market on the U.S. rates reset and expectations of Fed cuts.
Plus, as we said, our view from the C-suite, Rob Rich, he's CEO of the Optical Foundry, which sells eyeglasses, many manufactured, I should say, in Japan, outside the U.S. So he is a front seat to all of this. And then a really other good voice who is constantly talking to members of the C-suite, Tim.
Yeah, we got with us Alan Garino coming later, vice chair over at Korn Ferry, what he's really hearing from CEOs on the macro environment.
All right, let's get to it, folks. Let's get to that trade. We're off our worst levels, but it's still pretty ugly out there. Let's get to Charlie Pellet.
And here's what's going on. Stocks lower across the board. Do want to begin, though, with a development in the past hour involving TikTok. President Trump says he has decided to extend the deadline for Chinese firm ByteDance to divest TikTok's U.S. operations and give his administration more time to finalize a plan to keep the popular app running in the country. Stay with Bloomberg for the very latest on any TikTok developments. Equity markets lower across the board, as Carol mentioned. A lot of red today, right to the numbers, with the S&P now down 4.2%, down 225. A drop there of just about 4.2%. Again, now at 5171 on the S&P. The Dow above 39,000, barely 39,071, down 1,471 points. Off session lows, down 3.6%. NASDAQ is down 4%. The NASDAQ 100 index down 4.2%, and the Russell 2000 index of small cap shares down now by about 3.9%. The 10-year 4.00%, with a 2-year that's currently yielding 3.68%. Gold is plunging 2.9% to $3,025 the ounce. Gold is down $88 the ounce. West Texas Intermediate crude down 7.2%, $62.12 for a barrel of WTI crude, and Bitcoin up 2.4%, 84,352 on Bitcoin. The trade fight weighing hard on shares of industrials and materials companies. Among some of those names that are selling off today, we've got Stanley Works. Stanley Black & Decker actually is trading lower right now, down 3%. Caterpillar down 4.3%. Harley-Davidson down 1.5%. And Whirlpool down by 1.9%. All of those names trading at or near a 52-week low. Again, recapping, stocks are selling off. S&P right now down 4.1%. I'm Charlie Powell.
Virginia, and like many, Jay Powell noting that the tariff news is a bit more than everybody thought it would be.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
All right, that, of course, was Jay Powell earlier today at that event. For more on Powell and the moves we are seeing in the U.S. rate market, because that has certainly been something to catch everyone's attention this week. With us is Michael McKee, Bloomberg News international economics and policy correspondent right here in studio. And then we've got Ira Jersey, who's Bloomberg Intelligence chief U.S. interest rate strategist out there in New Jersey. Mike, I want to start with you. How much has Fed Chair Jay Powell's assessment of the U.S. economy and outlook changed because of this week's tariffs?
You know, in terms of Fed type of officials and communications, it changed a lot. Basically, he said today that the tariffs are worse than we anticipated, and the impact on inflation and growth will be worse than we anticipated. They don't have a good feel for how bad it will be, and they're not going to change their monetary policy right now. But he did sound more downbeat, and you know, hawk dove is kind of a silly way to put it, but he sounded more hawkish than he has been.
What was the one thing that the most significant thing, Mike, that caught your attention from what he said today?
Well, the big takeaway is that there's no Fed put, that the markets can go down as much as they would like, and as long as there are buyers and sellers, the Fed's going to stay out of it. There seems to have been some sort of a vague hope on Wall Street that at some point Jay Powell would step in and put a floor under the markets. And he made it clear today that that's not going to happen. That's not their job.
I want to bring you into the conversation, Ira, because it's hard to ignore what we've seen in the rates market. I mean, we had a 10-year that was below 4%. We've seen a little bit of a spike up today after kind of an earlier move down. Tell us about, first of all, from Fed Chair Jay Powell, what struck you the most?
I think it is the fact that they said that they could be patient, right? So that the market had been pricing for some 50-50-ish chance of a May rate cut, and that has gotten taken off the table. That's one of the reasons why you've seen this real whipsaw reaction in the rates market, particularly in the front end, in the short-term market. So you look at 2-year notes or futures on SOFR, which is now the new LIBOR, right? So the short-term interest rate instruments that we look at. And the market is, like you said, had been thinking, hey, maybe this is going to get bad enough that the Federal Reserve will cut interest rates sooner rather than later. Now, interestingly, and this has been our view for the last couple of weeks since we've been talking about tariffs and their impact, is that I suspect that the Federal Reserve will wait and need an excuse in order to cut pretty aggressively, and that has to be the job market. And when you saw this morning's job numbers, they were fine, right? They weren't great. They weren't like what they used to be in a couple of years ago, but they still weren't bad enough to be thinking that a recession is imminent within the next couple of months or even the next 2 quarters. But that being said, you get 1 or 2 bad employment prints, and the next thing you know, the Federal Reserve could be cutting interest rates pretty aggressively once again.
Mike, do you agree with that assessment that it's going to take a shock to the downside with the jobs report to get the Fed to cut?
Yeah, I think another takeaway from Powell today is that the Fed is still leaning on inflation. That's their main concern. And when you think about the process of what might happen going forward, inflation is likely to rise faster than unemployment because the tariffs are going to go into effect next week, and then we will start to see at a fairly rapid pace some things go up in price.
Where should we look?
Well, to a certain extent, you can look in food, but where we'll maybe see it first is in the PPI rather than the CPI, because intermediate goods that are going to come in that factories use to build other things. But and then in cars will be a big one. That one.
But we only buy cars every few years. Or if we live in New York, you only buy cars every few years.
Or if you're Matt Miller, you buy it more often. But
you know, in the average consumer's life, in the average voter's life, where should they be looking for prices to go up?
Well, I think that's what they'll notice. They'll notice the ads for it. They'll notice the newspaper comments on it, and just in the things they start to buy. I think I mentioned yesterday, Nespresso. The coffee pots come from Switzerland. Yeah. And they've already raised the price on Amazon by $10 for a box of ones from Starbucks. So we'll see inflation go up faster, and companies are still sitting on their hands because they don't know what's going to happen and how long this is going to. So the decision to cut people is always a major one, and that will take longer to play out.
Hey, one thing I want to get before you guys go, and let me start with you, Ira. I mean, President Trump came out and he said it's the perfect time for Jay Powell to cut interest rates. We did see money markets fully pricing in 4 rate reductions this year. Is that where we are right now? But again, and you often remind us, that can change too.
I mean, I haven't looked in the last 5 minutes since I've been on the air with you, so it could be completely changed. But we're pricing for more than 3, so I'll say that, and that's still a pretty big change over the last couple of weeks, right? Because not so long ago we were only pricing for 2, so that is a significant shift and acknowledgement by the market that growth is likely to slow down over the course of the year.
Mike, just real quickly, 30 seconds for you in terms of what we might get from policy, Fed policy. Is it still kind of up in the air?
Nothing in May, and June is when we get the next opportunity and the next dot plot, the next forecast. So that's going to be on the market's minds. But I think there'd be a lot of attention paid to almost every Fed speaker for a little while to see what they're thinking. By the way, we're now slightly under 4 rate cuts for the year.
Slightly under. Okay, good stuff. Lucky that you have a Bloomberg terminal in front of you.
Yeah. We should tell the audience to go out and get some of these.
I know if you're interested, I know where you can go.
He's got friends.
All right, Michael McKee, international economics and policy correspondent at Bloomberg News here in studio. Ira Jersey, thank you as well. Have a great weekend to both of you. Chief U.S. interest rate strategist at Bloomberg Intelligence. We got to talk the equity market.
Yeah, I see a red across the screen right now. I pull up world equity indices. Only 21 stocks in the S&P 500 moving higher. 482 are moving lower. The S&P 500 on pace for its worst two-day rout, going all the way back to March of 2020. It fell as much as 5% earlier in the day. Carol, the NASDAQ 100 set for a bear market.
Yeah, we saw the VIX topping 40. Gina Martin-Adams, man, she's been on the road a lot, really talking to a lot of folks. Today we find her on the West Coast. She is Bloomberg Intelligence Chief Equity Strategist with us from San Francisco. Gina, how are you kind of assessing the last couple of days, and has things really changed? And I am curious, is it just tone sentiment or is it fundamentals too?
Yeah, I think it's a little bit of both. I think that sentiment was still sort of in denial that the economy was already deteriorating prior to the tariff announcements. We got more news of that with the ISM New Orders series as well as the Challenger layoff series this week, which are leading indicators of what to expect come April in the real numbers. That and coupled with the tariff announcements does imply that the U.S. economy is on very, very weak footing going into the second quarter. And that was not adequately priced for the S&P 500 especially, which was still priced to anticipate something like 15% earnings growth, maybe even stronger earnings growth in 2025 on the eve of the tariff announcements this week. So I think you do have a sentiment, sort of a degree of sentiment unwind that is coupled with a fundamental deterioration that is now starting to get recognized now that tariffs are in play. Without a doubt, earnings expectations are still too high. Even with the repricing in the equity market, you're looking at earnings expectations of double-digit growth still embedded in S&P 500 prices. The run rate of new orders growth right now says you're likely to get close to negative 3% growth this year. If we implement sort of an expectation of much slower economic conditions emerging over the course of the second quarter, I wouldn't be surprised to see earnings contract greater than 5% in 2025 as a result of the tariff announcements this week. So we've got a great deal of unwind still to go in terms of sentiment and expectations to adequately price what is now our economic reality.
So from a valuation perspective, Gina, a question that I've asked you over the last couple of weeks, as we've seen this unwind, is how the S&P 500 is valued. And you've argued to us that it's still too expensive. That was a couple of weeks ago. With the sell-off that we've seen in the last few days, for people who are tempted to come in and buy this dip, what would you say to them?
Yeah, I think that's a really tough value proposition at this point in time. I mean, you're still looking at valuations that are well above average valuations on the index in an environment where we're going to really have to question the long-term operating margin reality for S&P 500 companies. If you'd spent a lot of your time over the last couple of years justifying elevated S&P 500 valuations because of record level operating margins, you're now really stuck in a really difficult position where the impact of elevated tariffs and reduced trade prospects for multinational companies means compression in operating margins. There's just no way to get around that. And if operating margins are going to compress, are going to strike a new reality in the U.S. as a result of globalization, the reversal of globalization trends, we're going to see valuations have to come down, at least closer to long-term average, if not below long-term average. And we're nowhere near that in the S&P 500. We're still sitting above long-term average. Now, there's a lot of opportunity for change to emerge later this year. I think that many company executives are saying, okay, if we can get deregulation, if we can get domestic supports, if we can get taxation changes, that could help offset this tariff risk. But those are all hopes right now. We're not seeing a lot of movement there. So we've got to see movement there to offset the risk of tariffs before we can get a real beat on operating margin outlooks for U.S. companies.
Yeah.
And until we can really get some stabilization, it is a tough call to make.
Are we dragging down the global economy at the same time? So is it a global market thing at this point, Gina? I was going to ask you, is the U.S., we've been talking about this, the U.S. being uninvestable. But we talk about how important the U.S. market is to the whole world, the economy. So are we talking more about a global market that is not going to be great for a while?
I think it's going to be really tricky for most global assets. There are very low beta components of the global market, and that means low exposure, effectively, very defensive components like the Middle East. The GCC segment of the world is one of the lowest segments, lowest beta segments of the world, tends to march to the beat of its own drummer, if you will, tends to be really levered to domestic conditions, which have less to do with U.S. domestic growth. Now, obviously, there are feedback loops. When the financial markets enter distress, the availability of capital globally tends to compress. So we've got to be careful with that. Latin America is another area. You know, you get deep into South America, Brazil, and surrounding economies there tend to be relatively isolated from what's going on in the U.S., though there are some dependencies. This had become a very globalized world, and we're talking about now cutting the U.S. off increasingly from a leadership position in terms of trade as well as a globalizer, and we're deglobalizing. That has tremendous complications for all of the world. The other economy that I would note is China. China has been reducing its trade dependence on the U.S. for the better part of a decade. That apparently is the right move because China is also going to be relatively sheltered despite the fact that we're implementing very high tariffs on the Chinese economy. China's much less dependent upon the U.S. than it was in the past, and as we've been deglobalizing, China's been establishing greater trade partnerships with the rest of Asia. So they might also operate as something of a safe haven, but it's tough to get around the fact that the U.S. is still the biggest economy in the world. We are seeing significant slowdown in economic conditions here, and that will definitely impact many global companies.
Do you see some sort of permanent shift here in the United States, Gina? I hesitate to use the term broken, but is that a concern to you?
It is a concern to me that we are really questioning the world order. We're upending the world trade order. We're changing relationships very, very rapidly and isolating ourselves increasingly from the rest of the world. That's a very different investing condition, underlying investing condition than most of us grew up with, where the U.S. was, increasingly pushing for greater globalization, greater relationships, closer ties to rest of the world, ways to create, more efficiencies in our supply chains. That's not the world that we live in right now. Will we work our way back there at some point in the future? Still remains to be seen. But for now, that's not the world that we live in, and we need to figure out this new world.
Okay, the reality. I just want you to know when I come back in my next life, I want to come back with Gina's brain. I'm just going to put that out there. Gina Martin Adams, Safe Travels Home, Bloomberg Intelligence Chief Equity Strategist, with us from San Francisco. Coming up next, we've got a few takes from the C-suite, including why one CEO says the tariffs are devastating for his business. This is Bloomberg Business Week Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all trading very close to session lows. We've got the S&P right now down 276 points, 51.19. That represents a drop right now of 5.1%. Steep losses with the Dow now down 1,860 points, a drop of 4.6%. The NASDAQ Composite Index is down 834, a decline there of 5%. Bottom line here, the sell-off in stocks is deepening. Bonds rose, oil trading at a 4-year low. The 10-year 3.97%, with the 2-year 3.64%. Spot gold down 3%, $3,022 the ounce. And West Texas Intermediate crude is plunging 7.3%, $62.07 on a barrel of WTI. Bitcoin higher by 1.8%, 83,766 on Bitcoin. Stellantis, the parent of Jeep, Chrysler, and Fiat, is offering employee discount pricing across its brands as the car maker seeks to lure buyers into its showrooms after President Trump's tariffs sparked fears of rising car prices. Ford shares, meanwhile, they're up by 1%. Stellantis down by 5%. Recapping, stocks are selling off. Keep it locked into Bloomberg Radio and Television for the very latest, and we'll keep you updated right through the close and beyond. S&P again down 5.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So, yeah, safe to say the understatement. It's been a tough week for investors, for business owners, for global leaders. We've got a global market sell-off underway. We've got that because a global tariff war is certainly underway, or feels that way. We'll have to see how it plays out over the next week. For the United States, in terms of tariffs, it takes us back to rates of nearly 100 years ago. Talking with those from the C-suite is super, super crucial for us. And someone who has a front row seat to this week's tariff news is Rob Rich. He is CEO of the Optical Foundry. They're based in Minneapolis. They sell eyeglasses to opticians in the U.S., Canada, and elsewhere. He joins us from Minneapolis on this Friday. Also with us is our own Nina Trentman. She's senior editor at Bloomberg News, the author of the CFO Briefing newsletter, which you can sign up for at Bloomberg CFO Briefing, Bloomberg.com/CFO Briefing. And Rob, by the way, is in this week's Bloomberg CFO Briefing newsletter that comes out on Sunday. Nina is why we are talking to Rob. Rob, we're so glad to have you here with us. We know you sell eyeglasses, but kind of lay out your business so that the Bloomberg listener and the Bloomberg viewer understand what you guys are all about.
Well, first, thanks for having me. And glad to be here. So our business is relatively simple. I mean, we design our eyewear and we source it overseas, and then we bring it to one of our warehouses, and we sell it then directly to the provider, being an optometrist, an ophthalmologist, an optician. So we don't sell to the end consumer. So we are in that middle area. And that's really just that's the nuts and bolts of what we do. This tariff has been an issue. We previously we did a little bit of our business with China, and the 301 tariff we absorbed pretty much across the board. But with the new stuff, we don't have the ability to absorb it. So we're just formulating exactly how big the price increases that we're going to implement are and when we're going to do that.
Yeah, maybe that's a good opportunity for me to jump in. Rob, thanks again for joining us here on the radio program. Talk to us a little bit. You said China is in your supply chain. I think Japan also is an important component. So how do you feel about those Japan tariffs that were implemented this week or announced this week?
When we were talking the other day or yesterday, I guess, was when those were literally in the middle of our conversation, when the Japan tariffs were announced. And I said to you, that's just a shot to my heart, because that's where almost all of our production comes from for our products. And, I was hoping that there might be some exemptions for medical devices, because that's one of the exemptions that has helped us in the past. It helped us with the Canadian retaliation from the last round was medical devices were exempt. So we did not have that issue with our Canadian business. But now with the 25% that we've put in, I think the retaliation is going to be greater. So we've got it kind of coming and going, really. bringing it in, our main source has been hit yesterday, which we have to figure out, again, what we're going to do. And then on the outbound, we're going to be hit because we do sell outside of the U.S. So, and when I say hit on that side, our buyers, meaning Canadian in this case, opticians, are going to be hit with a bill larger, and it's going to certainly slow down our demand. And the other thing regarding Canada, which is really, even though we weren't being hit at this point prior to yesterday, what it's done is it raised a significant amount of Canadian nationalism and anti-U.S. feelings when it comes to buying American products. And we were absolutely feeling that in the last month with our business in Canada dropping 30 to 40%.
Wow. So kind of like a triple whammy to your business just in the last few weeks. Rob, imagine if a member of the Trump administration's economic team were sitting right here. They would say, in response to you, this is exactly what it is designed to do. Instead of you contracting with firms in other countries, we want you to contract with firms here in the United States and build those eyeglasses here in the U.S. Are you going to do that?
No.
Why not?
It's even because the cost to make that happen, first, it's cost and timing, quite frankly. You've got a reasonably healthy investment. You can go automated to a degree, but that doesn't help the job market that they're looking to increase. There's a lot of labor involved in making quality eyeglass, even if you have a lot of automation. And quite frankly, people are not going to pay, I'll say, wages that would have to be paid in the U.S. To get that same exact product that even with Japanese, the way the Japanese do it, I can't speak to exactly how they're doing it, but I can tell you that we as a labor force right now are not competitive. And that is the biggest barrier I see. We can get machinery, we can make that investment, but
Rob,
the other side of the coin.
I want to ask you about rising costs, but first I want to ask you, is this possibly going to lead to you either letting go of workers or not hiring workers?
Well, we've already gone the route of made some decisions. We've had a couple of key people, and I say key meaning some of our people have made some decisions to exit, and we have not replaced them by design at this point because we just took the opportunity. It's not that there was anything. We can operate for some period of time right now without replacing those positions, and possibly even maneuver so we don't have to. But yeah, we're thinking of ways to conserve right now because honestly, I don't know what even tomorrow is going to bring, let alone there's no stability. It keeps changing every day.
Yeah.
Rob, how about those price increases? You said that would be one of the tools you have to take because you can't really offset those tariffs that are being implemented. When do you think you'll start to raise prices, and by what degree? Do you think it's going to be per product, per country, or do you already know what that might look like?
Well, I don't have an exact answer in terms of the magnitude. We're working on that right now. It's really the timing that I'm contemplating. Quite frankly, as I just said, everything changes on a daily basis with this administration. And, a lot of bluster and a lot of bullying, and who knows what the response is going to be and how quickly it'll be. I think maybe I don't necessarily implement the price increases next week. But if this does continue on, I would imagine by next month we'll fully reprice. The stuff we have in-house right now will carry us for that month that has not been hit. And then, our inventory starts to thin and we need to replace. We already have a lot of our production cycle is long between creating and getting. It's usually about a year process really before an idea becomes a finished product. So
Rob, I'm sorry for jumping in. We only have a couple minutes left. We have a few more questions on the price increases, on who absorbs them. How much do you think you'll have to raise the prices for the frames that you sell to opticians and optometrists versus how much of that cost you're going to have to eat?
Well, as I said before, the Chinese stuff that was done with 301, we ate. We didn't pass that. We don't have the margin to eat it with our cost structure on this Japanese tariff. So literally, whatever it's going to cost us, we are going to pass that through 100%.
Okay.
So a pair of glasses that cost, I don't know, $200. Let's make it simple. How much more might they be then for a consumer? Obviously, it's going to go to the optician or ophthalmologist. So glasses that are $200, I guess, that you sell to them, I don't know, give me an idea of how much they would go up.
Well, my guess is that that $200 pair of glasses will probably rise to at least $250.
Wow.
Yeah, that's significant. Yeah. Hey, one thing I want to ask you, and real quickly, if President Trump makes a 180 on the tariffs, I don't know, in a week, in a month, 2 months, I don't know what it might be. Will your longer term strategy, though, still change because of it? Because maybe you look at the U.S. and how it views its trading partners differently longer term?
Well, I mean, listen, my hope is that what will happen will be similar to what happened when he was in the first time in 2016. I have a lot of relationships, you know, in Europe and in Asia, and you know, they were looking at me with, you know, very funny, and I said, look, just let's wait this out. And quite frankly, everything sort of calmed down after he left the first time. I'm hopeful that this is another, you know, 4-year learning experience for us as a country, and then we get back to some level of, I'll say, normalcy. If this is the new normal, yeah, I don't know what those changes will be, but they probably will have to be some changes.
And do you, just thinking about changes, you've mentioned pricing to us, do you also consider other changes to your business at this point? Like I know one of your stores is called LAI stores, so could you consider rebranding? Could you do something else in order for people to not realize that you're a U.S. company?
And Rob, just got about 45, 50 seconds left.
Okay. No, I don't see that. LA Works is an iconic brand in the optical business. It's been around for 46 years. It is, you know, really a jewel, and there'd be no way that I would rebrand that name under any circumstances, quite frankly. So, no, I have not thought through that question beyond really the next month right now. Just trying to make sure we are profitable going forward.
Not easy though, right?
No, absolutely not.
All right.
Absolutely not.
Rob, thank you so much. And hopefully we can reach out to you maybe at a different macro environment as well. Rob Rich, he's CEO of the Optical Foundry, joining us there. And our thanks to Nina Trentman, senior editor at Bloomberg News, the author of the CFO Briefing newsletter. You can find it at bloomberg.com/CFO Briefing. It comes out on Sunday, and Rob will be in it.
Hey, I got my eye on the S&P 500 because we just bounced off the worst level of the day. We're close to our session lows, down 5.42% as we speak.
All right, coming up, another view from the C-suite. The vice chairman of Korn Ferry hearing, or what he's hearing from other C-suites. It's coming up.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Lows of the day right now on the S&P 500 index. 1 hour, 20 minutes to go until we wrap up the trading week. We've got the S&P 500 index right now plunging by 306 points, down 5.7%. The Dow is down more than 2,000 points right now. 2,098 on the Dow Jones Industrial Average. That represents a drop of 5.2%. Again, to put that in context, the S&P is down 5.7%. In the year-to-date column, the S&P is down 13.55%. NASDAQ right now down 5.7%, down 936 points on the NASDAQ Composite Index. The NASDAQ 100 Index down by 5.8%, and the 10-year 3.96%, the 2-year 3.63%. Gold is down 3% now at $3,021 the ounce. West Texas Intermediate crude is plunging 7.3%, $62.08 a barrel on WTI, and Bitcoin up 1.9%, $83,885. Bottom line here, the losses are continuing. S&P down by 5.8%. Wall Street banks are enduring another sharp sell-off after China retaliated against President Trump's tariffs with a 34% levy on U.S. goods. Morgan Stanley, Goldman Sachs, Citigroup, and J.P. Morgan Chase all lower. J.P. Morgan Chase will be reporting a week from today. That stock down 7.5%. Goldman down 8%. Morgan Stanley down 7.9%. Citigroup shares lower now by 7.8%. Recapping, S&P plunging 5.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As you know, President Donald Trump has extended the deadline for ByteDance to divest TikTok's U.S. operations by 75 days to finalize a plan to keep the app running in the country. There was a deadline until tomorrow, but then the president came out today and extended that deadline. Well, Tim, now we're hearing from ByteDance.
Yeah, the company says it has been in discussion with the U.S. government. It confirms that it's been in discussions with the U.S. government about TikTok. This is from a statement on its website. A pact, though, has not been executed. There are key matters that need to be resolved, and any pact is subject to approval under Chinese law. Once again, this is just in the last couple of minutes coming from a statement on ByteDance's website.
All right, let's get back to the general market environment, business environment, global environment. We've talked about businesses pulling back on CapEx, slowing global growth here in the U.S. And elsewhere. Tariffs, a global trade war, a global market sell-off, not an easy macro environment. And on a day like this, it is easy, as we talked about earlier, to kind of skip over a U.S. jobs report that showed growth exceeding forecasts for the month of March. It was backward looking. So we wanted to get a good gut check on the U.S. macro environment, what he's hearing from companies in the C-suite about the labor market and more. Alan Guarino is back with us. He's vice chairman in the CEO and board services practice at the executive search firm Korn Ferry, joining us from the West Coast. Alan, nice to have you here on a week that's been a little hectic, to say the least. A lot coming at business leaders, a lot coming at the markets. What are you hearing from the business community about the macro environment?
Well, thanks, Carol. It's always great to come on with you and Tim. You know, what we're hearing is, you know, what we've been hearing other than the last 48 hours of what I think we would all categorize as shock to the system. And so let's just recap. So we had a big jobs number on one hand, then we had tariffs on the other in the last 48 hours. You know, someone could say a trade war, right? But we had a strong economy going into this, people would argue, and we had low unemployment. So I think the best thing to describe this is that, you know, if I were a CEO today, I'd feel like I was driving a race car with one foot on the gas and one foot on the brake.
Wow.
And I think what that means is that, you know, as much as we'd like to have really solid, smart predictions, I think it's a wait and see, and I think that wait and see is probably in the window of 90 days. Will, you know, U.S. labor be competitive? Should manufacturing be able to return in some measure to our shores? It's just early times right now.
Listen, one thing I want to get to, though, too, Uncertainty, no doubt about it. You know, I'm looking at a market that is just getting worse, and we've got about an hour and 15 minutes to go, and we're looking at our major equity averages, Alan, at the lows of this session, something we haven't seen in a long time. S&P 500's down 6%. Dow Jones Industrial Average almost 2,200 points to the downside, down about 5.5%. NASDAQ 100 down almost 6%, down 1,100 points. You know, that does rattle businesses and leaders. Certainly if you're publicly held, you know, you look at your share price. What does this make you stop to, you know, do? What won't you do as a result of all of this?
So, Carol, honestly, you know, go back to Adam Smith. I think he said something to the effect that, you know, understanding history will empower you to know what to do. Let's think back, sadly, to the pandemic. I think we had a 30% peak to trough market move within a very short period of time. The market came back. So CEOs don't usually run their businesses based on the stock market. Yes, they run their businesses based on creating the right earnings, trying to defend their multiples, but I don't think 30, 60, 90-day windows in terms of market reactions to clearly identified outside shocks is going to change that. You're going to have some CEOs, let's just say there's job dislocation in this market. I don't think there will be, but if there was, that means that if some company's cutting back, there's going to be a smart CEO who's going to step in and acquire that talent. Just like, quite frankly, people are going to over the next couple of months, if this market continues to, you know, trade lower, are going to step in and start taking on stock positions that they would have liked to take previously that they felt were overpriced. So with all of this, let's call it somewhat chaotic market activity, it doesn't short-term change the way CEOs run and make decisions, especially on hiring.
So at this point, you're not hearing from CEOs that they need to pull back on hiring, they need to start cutting their workforce, because look, we did get a great number this morning from the March payrolls report. It's backward looking, but if we start to see stress there, that could actually prompt the Fed to move rates lower. You're not hearing any of that from the folks you talk to?
We're not hearing anything right now, and I think it's because of the foot on the brake and the foot on the gas situation. If anyone says they have enough clarity to make those decisions right now, I would tell you that they know something that 99.9% of the rest of the world doesn't know. So I think we'll start hearing that in probably, I'm going to say, 45 days, 60 days. And again, I think we'll hear it from both sides of the thinking here. Some that may want to cut, and others may want to take advantage of the opportunity that this talent is in the market. But right now, there's nothing shocking happening in terms of employment.
Alan, I want to go back to something that you said about these tariff announcements being a shock to the system. Why was this so shocking to the folks you work with each and every day? It was clearly telegraphed by the president when he ran. He told our own editor-in-chief, John Micklethwait, that tariff is his favorite word in the English language. We knew he was going to do this. Why was it still so shocking to the markets and shocking to the executives?
Tim, everyone's asking that question today. It's a smart one. It's a shock not because of what he did. I think it's a shock because people were expecting it to be less significant in terms of scale. So in that, they had to process not the idea that we had tariffs. And I'm not going to comment on whether tariffs are a good idea or not. I'm not an economist, and I don't think anyone knows how this plays out mathematically and in terms of actual market equilibrium. But I think the shock to the system was the scale, and there's shocks to the system frequently, and people get past it.
Hey, one of the things I wanted to ask you, and here we are again, just to remind everybody, since we're so focused on the market, you know, a second day of some extreme selling, S&P down about 5.6%, Dow down 5%, and the NASDAQ 100 also down 5.6%. Alan, the U.S. Labor Secretary earlier spoke to Bloomberg off of the jobs report. That was an upbeat one, and said that this wouldn't be the last positive jobs report under President Trump, and that companies are now investing billions of dollars in the economy. We're seeing this selling because there's nervousness because of the U.S. tariffs, a possible trade war, and then that leads to a U.S. slowdown and potentially a global slowdown. So the president has stressed all the money that will come back into the U.S. economy. Do you and leaders that you speak to kind of buy this idea that there will be lots of investment or more investment in the U.S., that we will see factories built, make things, create lots of jobs, that it will lead to an economic boom? I know what economists say and what history tells us, but what do leaders that you talk to say this? Do they buy this action and this expectation?
You know, I again, not hearing a lot enough to say, wow, there's a big trend here. But what I do hear is, there are places in this country where people could make a reasonable dollar per hour wage that wouldn't be egregious in terms of being competitive and have a terrific quality of life. And certainly that's not necessarily in the big cities. But if we bring in a situation where, free market of sorts starts to see some green shoots in terms of light manufacturing,
right,
then yes, the answer is it could be. And by the way, there's another thing to remember. It's something that Korn Ferry does. It's this notion of upskilling. So, as these jobs materialize, if this particular strategy works, then we're going to have people right now that are in, let's say, lower order jobs that make less per hour, perhaps get some upskilling and be able to go into a light manufacturing opportunity where they could make more. All of this is still speculation.
Okay.
Each of us could argue both sides. I quite frankly don't have a particular bias here. I try to look at it as measured as possible.
20 seconds. Everybody's not screaming recession or stagflation or the end of globalization. Just quickly.
People are worried about stagflation.
Okay.
People are expecting, recession because we've been expecting recession for 20 years. And again, I think we talk about the market. If we look at the market today, I think if you look at the 2-year S&P, today it's still up 35% over those 2 years or so. It's a big number.
Yeah.
So, a lot of the money that's theoretically coming off of people's portfolios today is money that they've, more than earned in returns. And again, if you don't sell today, you don't lose any money, right?
All right. Interesting and great perspective, and kind of gets us to where we want to go next because we want to go back to the markets. Alan Guarino, thank you so much. Vice Chairman in the CEO and Board Services practice at Korn Ferry, joining us from the West Coast.
Look, he's right. Still up 42% from those October 2022 lows.
Perspective, right?
Yeah. When in doubt, zoom out.
Yeah.
When you're looking at the portfolio.
No, I mean, we talk about this all the time. Let's talk a little bit more about the markets as we have, just to remind you of where we are. S&P 500 down 299 points, down 5.5%. The NASDAQ 100 also down 5.5%. It is a point drop of about 1,014 points. The Dow Jones Industrial Average down more than 2,000 points for a decline of about 5%. Let's get to Bailey Lipschultz. He follows the markets. He's Bloomberg News equities reporter. He joins us in New York. Hey, Bailey, good to have you here with us. General thoughts initially on this trade. Again, it's a second day of selling. I think we all kind of came into the office thinking, will we see a bit of a bounce today off of yesterday's selling? That's not what we got.
No, I think there was a lot of hope that yesterday would be the selling, to your point, and then we'd kind of rally or at least see green shoots going into the weekend. But when I've been talking to portfolio managers, folks at investment banks, the big concern has been China struck back. And what does that mean? And then Donald Trump came out saying that he's basically not going to renege on his current stance. So the big uncertainty, and part of the reason we're seeing a sell-off into the close, is do you want to be long stocks over the weekend if that's the positioning from the White House? And that's what we're waiting to hear from other countries that Donald Trump assigned tariffs to. Obviously, a lot can change hour by hour, and 48 hours over the course of a weekend is a long time, is a lifetime, seemingly in this ongoing trade war. But there's a lot of uncertainty. And when I talk to people, as your last guest mentioned, the stock market was basically priced for perfection and for the economy to continue to hum along and interest rates to fall because we have such a strong economic backdrop. And right now that's being questioned just because if this current stance continues to play out, where does that leave us in 2025 and 2026?
We saw a little bit of buying earlier in the session, Bailey, when we got the news that the president said that Vietnam is willing to eliminate tariffs on U.S. goods. He put this on True Social a little earlier in the day. Then we went back to our lows of the session just moments ago. But did this indicate to you, and do you think it indicated to traders that, hey, this is an opening salvo indeed, and that these numbers could change if countries come to the table?
I think that last part, though, Tim, is the big thing. If countries come to the table and meet Donald Trump how he wants to be met, when you look at the messaging from people in Donald Trump's camp, he's been waiting and talking about bringing kind of global trade back to an even playing field in his view for decades. So the thought that one phone call with a leader of a country is going to completely change his stance, at least from my conversations, is a bit kind of wishful thinking, if you will. Obviously, we've seen some of the companies that are exposed to Vietnam through their supply chain rallying on that Truth Social post. But again, just one comment in kind of this grand scheme, when you're looking at the tariffs that are allegedly going to be levied, there's still a lot of questions that need to be answered, and there still are a number of countries that would need to show up to the table.
You know, Bailey, I don't have to tell you this. You know this better than all of us. There's so many different metrics that you can look within the financial markets to kind of get a gauge of the health of a move, whether it's to the upside or the downside. There's lots of different metrics. We've talked about the VIX. Once again, we're looking at it at about 43. We've been as high as 45 today. I'm also thinking about IPOs, and we had kind of a rash of IPOs saying, nope, not going to enter this market. Fintech giant Klarna Group, ticket platform StubHub Holdings, pausing plans for their initial public offerings, according to those familiar with it. You know, that's not a sign of a healthy market.
No, but the big thing is, and again, I've been on the phone with a number of heads of these investment banks, is, as one put it, would you go for a run in a hurricane? No. And that's kind of the big thing with these deals is, if you wanted to market an IPO to new investors next week, you need to have a pretty darn good company and a pretty attractive valuation to get them to want to do the work, because when you talk to public investors, they're worried about their current portfolio and how the ebbs and flows of this trade war could impact it. So would you want to meet with a StubHub, to your point, Klarna, a number of other companies we've been reporting that are tabling those discussions for now? You do not. And simply from a company perspective as well, if your best comparison is down 20% in the last 2 days, you need to see some kind of valuation expectation, and that watermark has to move for you to kind of at least be comfortable bringing a deal to market. And that's something we've been tracking and are going to continue to track. And at least from the conversations I've been having with bankers, the expectation is, hey, we're not going to see a company on the road meeting with investors, best case until after Easter, if not closer to the end of the month, unless things change drastically. And we do have an expectation that that is going to be how it will be kept from the White House.
Bailey, let's take a look at some stocks on the move this week. Bailey Lipschultz is Bloomberg News equities reporter. Bailey, got a couple minutes on this. What's on your radar today?
Yes, you mentioned kind of the response from Donald Trump about Vietnam. We did see the likes of a Nike on the shoemaker, on Lululemon rebounding today, actually trading in the green, a handful of the few stocks that are trading higher really on most folks' radars. So this is signaling some optimism that maybe their supply chains that they intentionally had diversified away from China are actually going to be playing out in their favor. So again, a little bit of bottom feeding, but keeping things full perspective, these are companies that for the most part were deep in the red yesterday and now are only marginally higher. So again, Nike, one of your best performers in the S&P 500, along with some of those other apparel athleisure companies, but still a lot of questions around some of those other countries that they source goods from.
NVIDIA having another tough day, though.
Tough day for NVIDIA. One of the things we track is retail buying, and I've seen an overwhelming amount of buying on the Fidelity platform from what we've heard from the folks over at JP Morgan. So buying that dip, but this is a company that is so heavily predicated on being the driver of the market. So if investors are de-risking or de-leveraging, maybe even just taking some chips off the table after what's been a tremendous, really 3-year stretch, that's why we're seeing NVIDIA, again, being one of the many Mag 7 names helping drag some of these big benchmarks lower.
All right, finally, just 30 seconds on Tesla. What's going on?
We
Down
saw a big
10%.
rally after the election. Down 10%, Tim. Fundamentally, in theory, should be somewhat benefiting from supply chain tariffs, I think. But the big thing is such a big run-up and continuing to see concern around Elon Musk, the future with the government, with the company, and obviously another one of the many companies that, at least on a typical earnings multiple, is very highly valued relative to even the Mag 7 at like 4 times. So seeing that company taking on the chin as well.
Yeah, down about 50% from that mid-December high. So ouch. Bailey, thank you so much. So appreciate it. That is Bloomberg News equities reporter Bailey Lipschultz joining us here with some of the movers on this Friday. There are a lot of movers to the downside.
There are. And hey, if you're sticking with us on Bloomberg Radio, on YouTube, on Bloomberg Originals, we've got the chief strategist who foresaw the tariff shock and says the worst is yet to come. Yes, even after this week, we're going significantly lower by the end of the year. That's next on a Bloomberg Business Week Daily. The close is next on TV.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. The Dow continues to tumble off more than 2,000 points at this hour as the trade war escalates. China announced retaliatory tariffs. Business contributor J.D. Durkin says that will be very painful for some American companies.
So when you consider how many companies have revenue exposure to other parts of the world, especially China, right? You're talking tremendous downward pressure and really a loss of trillions of dollars for companies like Apple, Tesla, Qualcomm, even Caterpillar, a great American brand out of Texas that makes so much of its revenue up to 10% out of China. All of that uncertainty is going to weigh on investor sentiment.
American farmers, too, will feel the impact. China is halting chicken imports from 5 of the biggest agriculture exporters in the U.S. CBS's Weijia Jiang at the White House, where they're standing firm.
President Trump is not going to back down from this idea that he wants everything to be made in America. He really wants to be the architect of a new boom in manufacturing for the country.
President Trump's giving TikTok another reprieve while his administration brokers a deal to bring it under American ownership. Linda Kenyon has that.
President Trump has signed an executive order to give TikTok another 75 days to operate in the U.S. In a post on Truth Social, the president said there has been progress in negotiating a deal with the social media platform, but more time is needed to finalize it. Citing national security concerns, Congress had mandated TikTok be divested from Chinese ownership by January 19th, or it would have been barred in the U.S. But since then, it has been operating on a presidential extension, which was to have run out this weekend.
Democrats say they're outraged by President Trump's firing of the top National Security Council official and others. Christopher Cruz has that.
In addition to leading the NSA, Air Force General Timothy Hawk was also the head of Cyber Command. A senior intelligence official and a source familiar with the circumstances tells CBS News right-wing personality and conspiracy theorist Laura Loomer played a role in the firing. CBS News has also learned that others in the president's circle also pushed for Hawk's ouster. Sources say the 56-year-old four-star general's perceived close ties to the former chairman of the Joint Chiefs of Staff, Mark Milley, whom Trump despises, worked against him. Christopher Cruz, CBS News, Washington.
More dangerous weather is expected in the nation's midsection, including what some forecasters are calling potentially catastrophic rains. The Associated Press is reporting close to half of all local National Weather Service offices have a 20% vacancy rate, twice what it was 10 years ago. On Wall Street again, the Dow off 2,000. This is CBS News. Comedian John Oliver is being sued over an episode of his HBO show Last Week Tonight. CBS's Steve Kathan has that.
It was a show about Medicaid.
There was one last massive flaw with our Medicaid system. Now,
it showed clips of Dr. Brian Mobley. He alleges in a lawsuit they were taken out of context to make him the face of a predatory system. He says the episode that aired last year wrongfully implied that he had illegally denied services to patients. The segment centered on a severely disabled patient in Iowa whose Medicaid care had been cut off. A representative for Last Week Tonight called the lawsuit meritless. Steve Kathan, CBS News.
British police have charged comedian Russell Brand with rape and sexual assault against 4 women. The alleged offenses took place between 1999 and 2005. The investigation was sparked by a TV documentary. Brand denied the allegations, saying his relations were always consensual. I'm Cammie McCormick, CBS News.
This
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, a good afternoon to you on this Friday, April 4th.
Good. Excuse me?
I know. I like to be friendly.
Okay.
What can I say? I like to be nice, cordial. It's a rough day. It's certainly, as you say, we like to say there's two sides to the trade. So if you're short this market, you might be pretty happy. But a lot of investors who are long are not. We've got about 55 minutes to go until we wrap up the trade on this Friday and also for the week. It's been a rough one, especially the last 2 days following President Trump's tariff announcements. And right now, we're pretty much hovering near our worst levels of the session, almost 6% lower on the NASDAQ 100.
Yeah, we'll have more from Charlie Pellet in just a minute. Suffice it to say that in the S&P 500, there are only 15 stocks in the green, 488 to the downside.
I'm afraid to look at my gainers when we head over to our TV.
I would just don't look at your 401k. You'll be fine with your gainers.
Nope.
Don't open the 401k. We've got the chief strategist, though, who foresaw the tariff shock and says the worst is yet to come. We're going significantly lower by the end of the year. He's standing by. We're going to get to him in just a minute.
His forecast. You may have already read it on the Bloomberg, but it may shock you a little bit. We're also going to get into how Wall Street trading desks have been stunned by a once-in-a-century tariff shock. So we're going to talk about the Treasury trade, so important as well. I know we've talked a lot about the equity trade, but you got to watch what's going on in Treasuries too.
All right, and even though we've gotten the tariffs, the chaos, the uncertainty is far from over, at least according to Sean Donnan.
Aren't you glad you tuned in, everybody?
We were going to have, pets.
We were going to talk about pets.
We were going to have pets.
We're not talking about pets today. All right, first up, let's get to the trade, folks, because we're bouncing around the bottoms here. Let's head on over to Charlie Pellet.
Hi, thank you very much. We got pets for you. One big bear right now with the Dow, the S&P, NASDAQ. They're all in the red, looking at a drop of almost 2,100 points on the Dow Jones Industrial Average. Yes, you heard it right. I'll say it again right now. The Dow is down 2,073, drop there of 5.1%, with the S&P 500 index down 307 points, a drop there of 5.7%, extending the year-to-date loss to 13.4%. NASDAQ, the composite index, down 5.6%, with a 10-year 3.98%, the 2-year 3.67%. The sell-off deepening, bonds rose, oil at a 4-year low, as Fed Chair Jay Powell signaled the damage of a trade war will be bigger than anticipated. Spot gold is lower by $90 the ounce, down 2.9%, $3,025 on the precious metal. West Texas Intermediate crude down 6.9%, $62.35 a barrel. Bitcoin up 2%, 83,997 on Bitcoin. Stephanie Roth is chief economist at Wolfe Research. She says markets today are more focused on tariffs than they are on the jobs report.
These tariffs are so big, they are going to be very damaging to the consumer. And by the way, businesses have no idea how to invest in this environment. So you're going to see a sudden shock. I would look at this as a shock to the economy as opposed to something that's more domestically driven, in which case then those things tend to take a long time to work their way through the data. So the fact that today's data was strong doesn't really matter a whole lot in the context of everything else going on.
Stephanie Roth of Wolfe Research interviewed this morning on Bloomberg Surveillance. The trade fight weighed hard on shares of industrials and materials companies, including such firms as Stanley Black & Decker, the tool company. Also today we had Caterpillar down 5.6%, Stanley, by the way, down 4.6%, Harley Davidson now down 1.1%, and Whirlpool lower by 2.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Well, just after the U.S. election, when Wall Street was all in on the prospects of a business-friendly President Trump, Peter Berezin was sounding the alarm. He and his team at the research shop BCA predicted that broad-based unilateral tariffs were coming and that the new administration's proposals would go well beyond what had been implemented in Trump's first term. He was right, and now he says we've got a long way to go, lower before the end of the year. In other words, the worst is yet to come. Peter Berezin is chief global investment strategist at BCA Research. Their clients manage some $34 trillion. He's featured in one of the most read stories on the Bloomberg in the last 8 hours. He's based in Montreal, Canada. Peter, welcome to the program. You've got a 44.50 call on the S&P 500. We're at about basically 5,100 right now, so roughly 15% decline from where we are. Why are you so bearish?
I don't think the stock market has yet fully priced in a recession. I mean, keep in mind that up until a couple of days ago, the 493 S&P companies that are not the Magnificent Seven were still actually up slightly for the year. And these are generally cyclical companies that one would expect to go down in a recessionary scenario. So we're starting to see that being priced in, but we're not there yet. To get down to 44.50, which is my target, you don't need to make any wild assumptions. All you need to assume is that the forward P multiple drops to 18 and the earnings estimates fall by 10 percentage points. That's not crazy at all. On average, between 2015 and 2019, the P multiple was 16.8, and I'm talking about 18 in a recessionary scenario. So if anything, my target, even though going into this year, it was 1,500 points below the nearest person, might actually turn out to be a little bit too bullish.
Could we even go lower than that?
We certainly could go lower than that. I think it would require a deep recession, but we could get a deep recession if policy continues to be very unfavorable. And I'm not just talking about tariff policy. We also have kind of this discussion of the Mar-a-Lago Accord, this idea that perhaps holders of Treasury bills will be forced to roll their money over into low-yielding long-term bonds. I mean, this is crazy, right? The Treasury market is the ultimate risk-free asset. If we undermine the sanctity of the Treasury market, then we're looking at a worse financial crisis than what occurred in 2008.
This was supposed to be the year.
Wait, you said we could. Sorry, Tim.
Hey, go ahead.
I remember living through 2008. I know you did too. And I just remember,
you talking to me?
Yeah, I'm talking to you. I mean, Peter, we thought the financial market system globally was coming down. I remember not going to bed because headlines were crossing and it was like which Wall Street firm was being bought by whom and which one wasn't going to make it and so on and so forth and what the government was going to do. Say that again so that we understand kind of the heft of what you are saying.
The fact that the dollar is weakening now is very, very unnerving because the dollar is supposed to be a risk-off currency. You buy treasuries when everything is going to hell, and that requires more dollars, and that pushes up the value of the dollar. The fact that the dollar is weakening now is telling you that increasingly investors are losing confidence in the U.S. financial markets. And, you know, President Trump wants a lower trade deficit. The mirror image of a trade deficit is a capital account surplus. Yeah, if foreigners decide that they don't want to hold U.S. assets anymore, that's going to drive down the value of the dollar. That'll make imports more expensive, make exports cheaper. That'll result in a lower trade deficit. But we're talking about something that will also entail a huge decline in stock prices and probably a financial crisis.
So not exactly making America great again.
Not quite, no.
You know, it raises the question about how much damage can be done before you believe that Trump will reverse his policies, if that is something you believe.
Well, I think for one thing, we've already sort of passed the event horizon. I think at this point, it's going to be very difficult to avoid a recession just based on everything that's already happened. The economy wasn't that strong going into the latest escalation of the trade war. In February, real wage and salary income was only up 1% year over year. The CPI swap market is telling us that these tariffs could push inflation to well over 3%. We're potentially looking at negative income growth. That's going to be very difficult to maintain without the economy weakening significantly and spending drying up. So I think the outlook is quite worrying at this point, and it's probably too late to avoid recession. And I don't think that Trump is willing to reverse course anyway. He's been very, very clear, really for like 30 years, about how he wants to build this protectionist wall around the US. I don't understand where this groupthink came from, where people were just saying, oh, it's going to be a negotiating ploy. It's not a negotiating ploy. He wants something that resembles autarky.
Okay.
We're going to pick up on that, but we got to do a headline.
There's a headline crossing the Bloomberg terminal, and I'm going to work it into a question here. eToro is said to delay its IPO roadshow amid market volatility. Put that on the list of companies that we've heard from today or have been reported on putting their IPOs on hold. StubHub, Klarna, AdTech Group, MNTN, Insure, Integrity Specialty Holdings, Chime as well. Are you concerned that we're seeing financial conditions tighten too much right now? We could start to see some sort of panic or freeze?
Yeah, we estimate that easing financial conditions last year, mainly because of rising stock prices, added around 0.5 percentage point to growth. The fact that financial conditions have tightened, mainly because stock prices have fallen, credit spreads have widened, is based on kind of a very back of the envelope calculation, will shave around 0.5 percentage points from growth. And that's not huge, but the risk is that you get kind of in this feedback loop situation where stocks go down. That means people feel less wealthy. That means they spend less. So there's less sales, less profits, and even lower stock prices. That's what we often see during recessions. I think that's what we're starting to see now.
You know, I'm looking at something I think you either said or shared with Market Watch, and this was around late March 21st, and that even though you had this outlook for the S&P 500 this year of 4450 by the end of the year, and I think when you compared it to anybody else, it was the lowest on the street, you did have 5 scenarios that could boost stocks this year. And you talk about the president, you know, walking back much of his tariff agenda, kind of caving to pressure from the market, and a few other things. Do you still believe that there are scenarios where the market could actually rally?
There's certainly scenarios, and I wouldn't be surprised if over the weekend there's some comforting words from the Trump administration, but that's not my base case. I think that probably the trade war gets worse rather than better, because Donald Trump kind of had this, I'd almost say like naive idea in his mind that he's going to raise tariffs, and that's going to force other countries to reduce their tariffs. Well, there's 2 flaws with that argument. The first flaw is that most rich countries don't actually have very large tariffs against the U.S. and don't really have very large non-tariff barriers against the U.S. I mean, they have regulations. All countries have regulations, but they're not specifically targeted at U.S. companies for the most part. There's going to be exceptions, of course. So there's not a lot that other countries can do anyway. And the second thing, which is more politically relevant, we've seen, this is certainly true here in Canada, that retaliation is politically popular. Donald Trump has single-handedly resurrected the Liberal Party, which was heading for a huge defeat in the elections. And so people are saying, well, wait a second, if we can get more votes by retaliating, we'll retaliate. And so we're not going to get countries acquiescing to Donald Trump's demands. We're going to get retaliation, and that could very well spark another round of tariffs.
You know, one of the things I also wonder is that, is it possible that, this, I guess what I'm thinking about is what you said before, autarky. And that is the idea that, right, the U.S. produces everything that we need within our borders. Is that really, you think, the goal of President Trump? Because I think that's one of the things that we've tried to figure out with the tariffs, is that what's really his end game? What's really his mission here? But do you believe that his mission is that the U.S. is kind of self-sufficient in providing everything it needs for its citizens within its borders and then cut down trade?
I think Donald Trump sees trade as a zero-sum game, meaning that if one country is running a trade surplus with the U.S., then somehow that country is exploiting the U.S., ripping the U.S. off, as he likes to say. He doesn't see trade as something that can lift all boats, which is the way most economists see trade, nor does he kind of realize that the reason the U.S. has this trade deficit is because the U.S. has been a very good place in which to invest. Rather than buying U.S. goods, foreigners have been buying NVIDIA stock or treasuries. That has been a vote of confidence in the financial system. And if you force people to not buy U.S. assets. You'll have a weaker dollar and a lower trade deficit. But is that really what you want?
Hey, you mentioned politics a little earlier, at least from the Canadian perspective. Here in the United States, I'm wondering the sort of guardrails that you see on this president and his policies, because we're getting news now that Senator Ted Cruz, who's usually a staunch supporter of President Trump, sounded the alarm on the administration's move to ramp up tariffs, saying they pose, quote, enormous risks to the U.S. economy and make Republicans vulnerable to a, quote, bloodbath in next year's midterm elections. He said this stuff on his podcast, which was released today. This from our team at Bloomberg News. How do you see the guardrails around this president here?
So I think that's going to be what happens next. You're going to see more and more Republicans abandon Trump, and we're going to have real discord within the Republican Party. But unfortunately, the way the system works is that Trump does have a lot of discretion over tariffs. And unless his popularity plunges, and I would say like it's come down, but it hasn't plunged, he's not going to change direction. I mean, realistically, if you spent like a month talking about Liberation Day and then say, oh, wait a second, the stocks have gone down, just kidding. He can't do that without looking really foolish. And so he's not going to do that unless there's a lot more pressure. We're just not there yet.
Hey, one thing I want to ask you. All right, so if we buy what you're saying about 44.50 by the end, and it looks, certainly possible considering what we're going through right now, where are you investing or suggesting investors suggest this money? You guys advise a ton of advisors, share your research. Where would you be putting money in this environment? Or is it too late to move anything around right now?
I think it still makes sense to have a defensive bias in one's portfolio. That means holding more cash than one otherwise would hold. It means holding more bonds, although there's, of course, risk around bonds given the large fiscal deficit and the whole Mar-a-Lago Accord discussion. But nevertheless, the Fed probably will be forced to cut rates quite aggressively, more than what the market is pricing in. So you want to have more fixed income, less equity. Within equities, you want to own more staples, healthcare, these defensive sectors. And you probably also want to own a bit of gold now. I think that's a true safe haven asset.
What would you say to folks out there who attempted to buy this dip?
Listen, I mean, if you're nimble, you can, of course, do it. But I wouldn't buy it with the expectation that stocks have bottomed. I think we could get a rally that lasts for a few days, perhaps even a few weeks. But ultimately, if we end up in a recession, and I think that's where we're heading, earnings estimates are going to come way down, and that will drag stocks down with them. So I think it's too early to move to an overweight stance on stocks.
Well, it's like we like to remind everybody, markets don't just go up. They don't go in one direction. They go up and they go down. Hey, Peter, thank you so much. Double duty. We know you spent some time with our TV colleagues as well. Glad you could also spend some time with us as well. As we said, this story by our Vildana Hyrick, it is one of the most read stories on the Bloomberg. Peter Berezin, he's Chief Global Investment Strategist at BCA Research, joining us from Montreal, Canada. Peter, thank you so much.
Hey, coming up next, we're counting down the TikTok to the TikTok, which just got extended. We're going to have the details in just a minute. First up, though, a check of the day's trade and top business stories as we're off the worst levels of the day. Hey, Charlie Pellet.
Thank you very much indeed. As Peter Berezin was talking, he referenced 4550 on the S&P 500 index, 4450. Where we stand right now, 5123. To put that call in perspective, we've got the Dow, the S&P, NASDAQ all declining. Tim mentioned we're off session lows, true, but still down 5.1% on the S&P. A drop there of 273 points, 5122 where we stand now. The Dow is down 1893. That is a drop of 4.6%, 1,890 on the Dow. The NASDAQ Composite Index is down 803, a drop there of 4.8%. 10-year at 3.99%, with the 2-year currently yielding 3.67%. Gold down 2.7%, 30.30 the ounce. And West Texas Intermediate crude has plunged 6.3%. 3%, 62.70 for a barrel of WTI. So again, the Dow, the S&P, NASDAQ all declining. Tech stocks hard hit today. Case in point, Apple down another 6.2%, Nvidia down another 6.4%, and Tesla is slumping by 9.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie. Do appreciate it. Well, just before we came on air, we got the news that President Trump has said that he's decided to extend the deadline for Chinese firm ByteDance to divest TikTok's U.S. operations and give his administration more time to finalize a plan to keep the popular app running in the country. Trump said he will give Beijing's ByteDance an additional 75 days. Remember, it was April 5th was going to be the deadline, this deadline.
And
there've been others.
Let's not forget it stopped working for a while, right? It was shut down in the U.S. for just a beat. It's just
but
like...
then we had to get it back.
You know, like Snoopy and Charlie Brown and Lucy. Was it Lucy that always like pulled the football out? That's what it feels like constantly. Sorry. TikTok football. All right, go on.
I think you're right. They were supposed to agree to this deal that would sell TikTok's U.S. operations to an American buyer and avoid a ban that was set to take effect as soon as this weekend. For more, we want to bring in Michael Shepard, Senior Editor for Technology and Strategic Industries at Bloomberg News. Also, Kurt Wagner joins us. He's Bloomberg News technology reporter. Kurt is also the author of Battle for the Bird, Jack Dorsey, Elon Musk, and the $44 billion fight for Twitter's soul. Michael, I want to start with you out in Washington, D.C. ByteDance, we got some comments from ByteDance. They've confirmed that the talks are ongoing as Trump announced this extension. What are the proposals right now that are being reviewed?
Well, the one that seems to be gaining the most favor and is viewed as the leading contender would actually not completely wipe out ByteDance as an owner in this new U.S. app that the plan would call for. Instead, what you would see is their holdings diluted to below 20%, and that would allow it to fit within the parameters of the law that Joe Biden signed last year, calling for Beijing-based ByteDance to divest to below a certain point and lower some of the national security risks associated with that. They would no longer have a controlling stake in it. Instead, you would see investors including Oracle Corp, Blackstone, and perhaps Andreessen Horowitz also join in buying up, together with other investors, a 50% portion of this venture. And then ByteDance American investors would buy another 30%. And the idea would be that it would be an American operation, still with some nominal connection to ByteDance, but that in doing so and allowing this ByteDance ownership to remain, that would perhaps make it easier for the company to sign off on the deal and then also win the blessing of authorities in Beijing, which is no small matter.
All right, wait a minute. First of all, I don't even know who to ask. I want to ask both of you. Kurt, let me bring you in. Is there even a nominal connection to ByteDance? Is that even possible? If the concern is about any connection with China and potentially the Chinese government, is that even possible?
So the ownership breakdown that Mike described is possible under the law. I believe ByteDance could own, as long as it's less than 20% of this company, that would be allowed. But what would not be allowed, and where the sticking point is, in my opinion, is on the technology itself and control over the algorithm that people, that is used to show people posts in their feeds. So under some of the previously reported kind of discussions and plans that have been floated to Trump, ByteDance, even though they'd have under 20% ownership, would still control this algorithm. And according to the law, that is not allowed. And so ByteDance doesn't want to give up control of the algorithm. The law says they have to give up control of the algorithm. So to me, it's less about the ownership here that's the sticking point, and it's probably the technology and who gets to control it that's the sticking point.
Right, the holy grail that makes TikTok TikTok. Michael, come on back in here. Is that what's kind of making these negotiations tricky? I'm curious what you guys are hearing from the White House, because it is interesting that it's not like we've just said, that's it, TikTok's done. They keep expanding, the timeline here and extending it. So is that what's holding it up, is what's up with the algorithm and who really controls it?
you know, Carol, it's a good question. You know, we don't have that much visibility into what is exactly happening behind closed doors in these talks, but the algorithm certainly is a sticking point. The law was very clear about whether ByteDance or any Chinese entity, for that matter, could remain in control of this really valuable technology that also allows potentially a window into American users and also a vehicle for perhaps disseminating propaganda in the U.S., which was another concern cited by U.S. policymakers when this was passed. So that is certainly one of the sticking points, but there are many others too, including ByteDance, for instance, just overall doesn't like the idea of this sale. They found it objectionable all the way back in 2020 when Trump first pushed the idea. Remember, he originally signed a ban, an executive order banning the app, and then set about trying to find a U.S. buyer. Of course, those efforts kind of just fell apart during the pandemic, among other things, and legal challenges too. But for ByteDance, this has from the start been a non-starter. The fact that they're confirming some discussions today is news, and it's really the first we've heard from them saying that they are in talks with the U.S. on this.
Hey, Kurt, who do you think in your reporting is the most serious contender to take over ByteDance's U.S. operations, TikTok's U.S. operations?
Well, I think there's a difference perhaps between who's the most serious and who's the most likely, because I think there are actually a lot of serious contenders, including, you know, Frank McCourt and Project Liberty. I mean, they're very serious about wanting to do this. But do I think they're maybe in the driver's seat? I would say probably not. I think Oracle, maybe to get to the real, you know, point of your question, like who is the most likely? Yeah. I think Oracle is probably the most likely to be involved here for a couple reasons. Number one, we know that they were part of the consortium of investors that was reviewed in the Oval Office on Wednesday by Trump and some of his aides. We also know that they have an existing relationship with TikTok. They already work with TikTok on cloud services, on data storage. And we also know that Oracle chairman Larry Ellison is a Trump supporter, a Trump donor. And those, because of those reasons, I think Oracle has sort of taken the lead in terms of who is almost guaranteed to be in a proposal from Trump. Now, again, as Mike pointed out, a lot of this depends on whether ByteDance and the Chinese government ultimately agree, which they may not. But the proposal that Trump puts forward, I think we all expect to have Oracle probably involved.
You know, Michael, one of the things I wanted to ask you is how much of these conversations are also related to the tariffs imposed on China. I'm just curious if it all kind of folds into one.
Well, you know, in the end, we joke here in Washington that it's all one story, and Trump has certainly tried to connect these two issues. The question is whether officials in Beijing share that view, that you can lump these things together. If you're Xi Jinping, for instance, do you think that there is such an easy trade-off between, you know, this company, ByteDance, that is considered a local star, and then the massive tariffs that Donald Trump has just imposed on so many exports from China into the U.S.? And, you know, is there really something else to be gained here for Xi Jinping by doing one thing or another in terms of this with Trump? Trump has reiterated his offer to China of perhaps lowering tariffs in exchange for getting some help and winning approval for a deal. Now, whether Xi Jinping is willing to do that, let's take a look and see.
Yeah, certainly. Kind of interesting to see what comes next. Hey, just real quickly, Kurt, Amazon, are they out? Are they even a contender too?
They are a contender. They did submit a bid. It's unclear exactly how serious it's being taken, but they did submit a bid this week, as we reported. If I could just make one final point on this about what's happening this weekend. Again, because this executive order was signed to extend this deadline, we presume that TikTok will continue to operate. But you may remember that last time around in January when there was a ban, even though Trump said, hey, you guys have more time, the tech companies that support TikTok, that put TikTok in their app stores, or in Oracle's case that provide these cloud services, they were actually worried about following the law and didn't always take Trump's sort of executive order as being good enough for them to keep working with TikTok, right? So we have reached out to these companies. We're asking, hey, do you plan to continue to support TikTok technologically during this time? Because if you're Apple and you're sitting there going, hey, even though Trump says it's okay, a future president could come in and there are massive fines that they could face for breaking this law down the line if they choose to do so. So I think that's something we're going to be paying attention to, is even though Trump says it's fine, do their tech partners believe enough in his word to continue to support TikTok and keep it operational? And we'll only know that, over the next 24, 48 hours if we see whether it goes offline or not.
All right, so 2 clocks ticking, 24, 48 hours, and then, of course, we've got 75 days because of the president's extension to figure out what's next for TikTok in America. Hey, guys, thank you so much. Have a great weekend. Mike Shepard, Senior Editor for Technology and Strategic Industries at Bloomberg News in D.C., and Kurt Wagner, Bloomberg News technology reporter. He's there in Denver. All right, folks, we've got a market coming off our lows of this session, still down 4.5% on the S&P 500, NASDAQ 100, down about 4.4%. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Steep losses for the U.S. equity market with the Dow, the S&P, NASDAQ all declining. Yes, off session lows, but still a drop of 4.7% on the S&P. Let's head right over to the first word breaking news desk for today's afternoon call. Lots going on. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are plunging again today as China announced 34% tariffs on U.S. goods. The Dow is currently down 1,800 points. Like you said, S&Ps are down 4.7%, and the NASDAQ is off by 4.4%. The U.S. 10-year yield is sitting right at 4%. Gold and oil are sinking, and Bitcoin, that's higher by 2.5%. Among the main 11 S&P sectors, energy, financials, and materials are under pressure, and leaders to the upside on the Dow, Nike and Home Depot, while Boeing fell 8% and led to the downside. Regarding the tariffs, Nike and Lululemon spiked intraday after Trump said he had a productive call with the General Secretary of Vietnam. And regarding IPOs, multiple IPOs have been postponed, including Klarna's. In other news, Trump says he will keep TikTok up and running for an additional 75 days. And wrapping things up, Powell says the Fed is well positioned to wait to consider adjustments. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill. Have a great weekend. And to hear live breaking news over your Bloomberg type squawk, SQUA on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the drive to the close.
Funk the music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. TikTok, everyone. It's about 18 minutes to go until we wrap up the trading day and the trading week, and really a rough 2 days of trading. As you just heard from Bill Maloney and Charlie Pellet, we are looking at the major equity averages here in the United States bouncing off their lows of the session. We're still, though, down a lot by most measures. S&P 500 down 4.8%. That amounts to about 260 points to the downside. NASDAQ 100, that's where you find a lot of those large cap tech names, down 4.7%, a decline of 879 points. Dow Jones Industrial Average down 4.4%. It is down 1,793 points. And, I was kind of looking at the week overall here, and in terms of industry groups, and what we have seen in terms of drops, we have just seen incredible drops. Forgive me, I'm having a hard time bringing up. Here we go. One day I'm just looking at kind of, it's just clicking. It's not happening.
It's kind of how I think everybody feels at the end of this week, Carol.
I was trying to get
What are you trying to do?
Oh, I know what I was trying to do. I went in actually to the energy names. Here we go. Because 5 days, energy just getting smacked down this week. I was digging deeper and I got caught in it. Down about 13% this week overall. Even consumer staples, which is where you kind of go when the markets are rough, still down about 1.5% for the week overall. But let's see what Megan Horniman, who's been sitting by patiently as I get lost in my Bloomberg, Chief Investment Officer at Verdance Capital Advisors. I feel like, Megan, I've been at Bloomberg a long time. Tim's been here for a bunch of years. It's like you start digging down deeper and deeper, and it's very easy for us to get lost in the Bloomberg as we kind of dissect these markets. As you dissect these markets, the week, the past 2 days, what do you see?
I think this is kind of a resetting of expectations. That's what we're telling our clients. We're looking at not only expectations for growth now coming down, the likelihood of a recession rising. Inflation is really still an unknown. And then you have analysts trying to wrap their head around the earnings expectations. So we're getting this complete reset of valuations, reset of earnings estimates, reset of economic growth. And we've often seen that when you get these sharp resets, this can be painful. It can be difficult to watch. It can be the markets can also swing much more, to the downside, even the upside. And we typically see this happen, and that's what we think is unfolding here over the past couple of days. Is just trying to reset what we think these new tariffs mean.
I'm going to go with the opportunity in a day like today, in a week like this week, Megan. Is there an opportunity to be a buyer right now?
Yeah, absolutely. We've been waiting coming into this year to see some sort of a reset in valuations. Let's take the tariffs out of the equation completely. Coming into this year, growth was already slowing, and we knew that. Even analysts were expecting a slower economic picture for this year, but nobody had downgraded earnings estimates, and that was shocking to us. So we've expected to see some volatility, and we knew that there was this unknown with tariffs and the new administration in general. So we expected that volatility to pick up. We've been gradually piecing away as we've gotten some of these downturns. You know, we had a brief 10% correction in the S&P 500 earlier this year. We're now past that in correction territory and bear market in some indices. So we've been taking some of our cash that we came into this year and putting this to work. We've looked at the small and mid cap space because they're getting really beaten down by the fact that, again, they do carry debt and they're a higher risk sector, but they also tend to be a little bit more domestic. So can they be a little insulated from this? And also in the large cap space, while we aren't ready to jump into your Magnificent Seven or really the growth or tech, we are looking at some of the value areas.
Okay.
These areas have been beaten down too and offer opportunity.
What about geographically, going outside of the U.S.?
So we added to our developed international exposure at the end of last year, and we haven't added more to it. We're pretty comfortable where we are at this point. If there's investors that haven't, you're getting it cheaper today than you did even just 2 or 3 weeks ago. So it still is something we like for the long term. And just over a longer period of time, the developed international still are cheap compared to the U.S. markets.
What would make you jump back into mega cap tech or just the large cap stocks in the S&P 500? What do you need to see?
I think you see some more downside. I don't think that it is reflecting at all. I mean, valuations are still priced at a premium to the historical average. The S&P 500 itself, when you look at just the PE, it has come down. So it is correcting, but it's not like it's overwhelmingly cheap. What we want to do is find when the market is pricing in all of the downside risks. And we think certain pockets of the U.S. equity market are. We thought that, certain pockets of the developed markets have been pricing in the downside risk. But that tech and large cap growth, I just don't think is there quite yet. I'd want to see some more downside there.
I just want to ask you about, your thoughts on how you guys believe, or you believe that, I'm just looking at some of the notes that you shared with our team, that how the president and some of his administration are calling for this kind of whole rethink, reorder of global trade. This is a different beast. And I just wonder, if we change the entire global trade landscape, is that a good or bad thing in your view?
Well, it depends on to what degree. So we talked about this on the podcast that I do here at our firm the other day. No longer are tariffs being used as a punishment for the fentanyl crisis or immigration. Now it's a tool to really reorder this entire global trade system. I think in the long run, this can have many benefits, but I don't also think that what we saw on Wednesday is what we're going to see for the long term. I still think you're going to see quite a bit of negotiations. Wow. And we've seen this from the Trump administration.
If that is indeed the case, we're getting such mixed messages then, right? We got the Vietnam news earlier. We saw a little bit of buying as a result of that. Maybe it means countries can come to the table. But the president also said as much, I'm not backing down from this.
On the other side, he's also said he would make some adjustments. So we were getting that rhetoric from the White House that we're used to. It's kind of that back and forth. But let's just look at the picture.
We only have a minute left. I just want to jump in because if you're a CEO trying to run a company right now, how do you get used to that?
Right. It's difficult, but I still think you have to figure out where you can change some of your sources. How can you adjust things if you take those tariffs that were announced on Wednesday, and let's use that as the worst case scenario. So there's really only a way to go from there is up. So factor in some things from the worst case scenario. Figure out supply chain. Make sure that can't get disrupted. Think about your margins. Think about what you can adjust. But I don't necessarily think this is a bad thing for the long run. I still think companies will adjust. We've seen that with U.S. companies, very resilient, and find a way to adjust with all political environments.
Interesting. So.
By the way, I was wrong that we only had a minute left.
That's okay.
Megan. We're keeping you. Okay. We're keeping you.
Because I could have went longer.
No. That's okay. That's okay. Well, continue then in terms of your thoughts on this.
Yeah, I think so. From what we got Wednesday, this is what we've told our clients. That's the worst case scenario. So this is what Trump has done. We're used to the rhetoric. He comes out strong. He comes out with all swinging, so that somewhere we can meet in the middle. I'm not saying that all these tariffs are going to be wiped away. I'm not saying that some of these won't stay. I think we should adjust to the fact that we are resetting the global trade relationship. But don't think that globalization is completely gone. I just think this brings countries to the table to say, okay, what can we work with? And over the next couple months, I think you're going to see a lot of negotiations between the Trump administration and these countries. I think a country like China is probably going to play a lot more hardball, be a little bit more stubborn. But think about the countries like Vietnam, Japan, some of our biggest allies. They're going to be inclined to come to the table and figure out how we can work this through.
So would you tell people to buy the dip here? Buy this sell-off?
Start, yes. I think if you haven't started in the first 10% correction we got this year, start putting some of your cash to work. Yes, and we're long-term investors, and long-term investment cycles go through many different politicians. So it's 4 years in office, and if going forward, you got to just think of, is this tariff impact that's today going to be the same tariff impact in the next 18 to 24 months?
But
I don't think so.
I think one thing that concerns investors is they hear comparisons to the Smoot-Hawley situation that was, exacerbated the Great Depression.
For those are on radio, I'm just going to say, Megan kind of had a smirk there.
Who did? Who had a smirk?
Megan.
Oh, I didn't see.
Anyway,
Thank you for keeping me honest. Why are you smirking about that, though? I think there is some concern that something fundamentally is shifting here, that the world order that we grew up with, that we are so used to, that the way of doing business is fundamentally shifting.
I think that it is shifting, but I don't think that we have to go. We're not comparing this at any point right now to the Smoot-Hawley tariffs. I understand that the problem that investors are having as well is that's what they're seeing in the headlines. So like you mentioned when we started this, there's one side or the other to this tariff situation. There's nowhere in the middle. There's no economist or, we came in on Wednesday evening, everything I read was this is the absolute worst case scenario, so much worse than anybody anticipated. That's the first stab at this. We know that we have a negotiator here. So I think that we have to take a step back. Remember that he's campaigned on this. He was elected by the majority of the U.S. population or U.S. voters that he would change this to make it more fair trade for the United States. We're not going to bring every manufacturing plant back here. But can we make this a little bit of a better playing field? That's what he's trying to accomplish, and that's what he got elected on.
No, forgive me. Let me just break in because we did have the U.S. Labor Secretary, and I asked this of an earlier guest who just talked about this is not going to be the last positive jobs report under President Trump, that companies are now investing billions of dollars in the economy, the U.S. economy. So do you buy the idea that there is going to be a lot more investment in the United States, that we are going to build factories, we're going to make things, that's going to create jobs, that's going to be an economic boom? And is that what we really want to be, as a manufacturing economy? I have nothing wrong with manufacturers, but I'm just trying to understand, is this the kind of economy that really is the top economy in the world?
Well, there's the difference there is, do we want to be what we were 50 years ago? I don't think that's possible. But can we be something better than we are from a year ago? I think that is possible. And that's where I think there is going to be, we've already seen it, quite a bit of investment back here in the United States. And let's not forget, we're one of the biggest technology, just smartest people here that we have from a business perspective on the technology front. And, whether it's artificial intelligence, these are things that we can do quite a bit here in the United States. I don't think we'll ever be what we were before, but we can be better than what we've been.
We can do quite a bit, but we can't do a lot. We spoke earlier today with Rob Rich, CEO of the Optical Foundry. They're based in Minneapolis. They've got, Carol, 50 employees here in the U.S.
Yeah.
What they do is they sell eyeglasses to opticians in the U.S. and Canada and elsewhere. They source mostly from Japan, but also from China. They have some operations in Europe as well. I asked him, can he do this in the U.S.? He said there's no way he can do this in the U.S. He could buy the machines, but there isn't the talent here to do this. The same thing when it comes to apparel companies. We're not going to start making shoes here like they do in Vietnam. We just can't do that here in the United States.
Yeah, and you're exactly right, and he's right too. There are some things that we can't do here because of the labor force. There also is something that you've heard many of the politicians in the administration talk about, and that is retraining workers to different skills, and that's something that I think they'll see an effort to try and do that as well. But we're not going to be what we used to be. This trade, the trade and the tariffs and everything that's going on now from the trade perspective is to try and make it a little bit more fair to U.S. businesses, even to sell their products elsewhere. That's what the attempt here is to do. And if you think that the American businesses can adjust to this and can flourish under this over the longer term, then this is a good buying opportunity. I'm not saying we can build a plant in 2 years or a plant overnight. These are things that all have to be sorted out. But I do think in the longer run, are you worried that American businesses aren't going to be able to survive with what's going on? I'm not at all.
Hey, as we're talking, Megan, we're seeing the S&P 500 hit its worst level of the day, seeing some selling into the close. We're actually down 6% exactly on the S&P 500 right now. If we see selling in the next few minutes, what's the signal it sends to you?
We've seen this before with all the administrations. To go back to the Great Recession, this happened regularly as well. Nobody wants to go into the weekend. No one knows what's going to happen over the weekend. There have been other countries that have threatened retaliatory tariffs. We've really only seen it from China. Will we get some more information over the weekend? This is what we see. It's not surprising at all to me that on such a down day, going into a weekend with so much unknown, that we may see some selling into the close.
Hey, really quickly, 30 seconds here, Megan. What's your expectations for Fed policy? Now, we did hear from Jay Powell earlier today in a speech. Do we need to see a rate cut or several rate cuts, or what are your expectations?
Not right now. I still think they have the flexibility to be on hold in May and possibly even June, because it's going to take some time for all of this to filter into the economic data. But I do think it sets them up to be able to have that flexibility in the second half, which would also be a positive for markets. So would passing the Tax Cuts and Jobs Act.
All right, going to leave it there. Hey, listen, so appreciate the time that we had with you. Have a good weekend. Megan Horniman, Chief Investment Officer at Verdance Capital Advisors, joining us from Maryland. Hey, folks, as Tim mentioned, we have taken another leg down here in the final few minutes of trading. So what does that mean? We've got an S&P that is down just shy of 6% as we speak. Dow Jones Industrial Average down more than 2,200 points, a decline of about 5.5%. The NASDAQ 100 also just under the 6% decline mark, down 1,100 points, 1,104 to be exact. And we're looking at all of the major industry groups in the S&P 500 down for the week overall. Some really deep losses, 14% lower on the energy market. Information technology down about 11%. Financials down about 10%. I'm looking at a lot of red on my screen.
Yeah, only seeing 14 stocks in the green in the entire S&P 500 right now.
I'm not hopeful for my gainers. We'll see. Hey, do not go anywhere. We're heading over to our TV colleagues, our simulcast, The Closing Bell. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through the global closing bell. A global simulcast starts right now. Scarlet Fu back from vacation. Carol Massar and Tim Stenovic still here in what's been a very relatively exhausting week for everyone involved as we welcome our audiences across our Bloomberg platforms, including our partnership with YouTube with Stocks. Carol Massar now back at the lows of the day. The S&P down 6%.
Yeah, we were looking really closely to see whether or not we saw any kind of buying into the close here. But as you mentioned, Tim, Romaine, definitely taking another leg down. So we're looking at what, the worst week for stocks since March of 2020, back smack in the middle of COVID, in the beginning of COVID. And we've got what, the S&P losing something like $5.2 trillion worth of value, market value this week. So yeah, definitely one for a major, major risk off. Really coming off of course, President Trump's tariffs.
Look, not a good thing ever to talk about comparisons with the height of the sell-off during or ahead of the COVID pandemic, but we are seeing the worst day on the S&P 500 since March 16th of 2020, when that index dropped close to 12%. But we've given up our gains on the S&P 500 for going back almost a year. It's right now trading at a level that was last seen back in May of 2024.
Yeah, and let's not forget, too, it's Friday, and who knows what's going to happen over the weekend. People don't necessarily want to be long over the weekend because there could be a whole lot of pronouncements, there could be some deals announced, and you don't want to be exposed to that. Having said all that, the rally in treasuries, the safe haven of choice, it's really lost a lot of steam here.
All right, we are getting the closing bells here in New York. I do want to point out, too, equity option volume from both stocks and indices looks like it has actually hit a record high. It'll take a little bit while for us to get the final numbers on that. But remember, yesterday was the second most active day in the equity options market on record. And it looks like today has surpassed that to overtake a record that was set back a few years ago. The Dow Jones Industrial Average that you're looking at on your screen right now, closing out the day lower by 5.5%, a drop of 2,232 points, now settling at 38,313. The S&P 500 below 5,100, a drop of more than 300 points, or 6%. You add that to the 5% from yesterday, and well, you can just do the easy math yourself. The NASDAQ Composite down 1,000 points, or about 6% as well, and the Russell 2000 down 83 points, or 4.4%.
Yeah, let's not forget, too, we saw credit fear gauges soaring, so a lot of nervousness in this market. We understand why. I look at the S&P 500, guys. Almost every name is lower. 489 names losing ground, only 14 gainers. And again, S&P 500 ending the week down 9.1%, biggest decline since March of 2020.
And we should just point out the S&P, deeper into that correction territory. The NASDAQ 100, it is official. It is in a bear market, down more than 20% from its all-time high score.
So it should be no surprise then that when you look at the IMAB, it is a sea of red. Every single industry group in the S&P down at least 4.5%. If I were to look at it on a 24-group basis, there is one group that did buck the declines: consumer durables and apparel. And that's tied to Vietnam, of course, because if Vietnam actually drops the tariffs against the U.S. and Trump, of course, ameliorates the situation with Vietnam, that could be good news or less bad news for companies that rely on manufacturing in that country.
Well, that's a great setup for me because Lululemon is one of those names that could certainly benefit if we see a backing off of those tariffs against Vietnam. Lululemon, your second best name in the NASDAQ 100 today, guys, up about 3%. Earlier in the session, it was up more than 6%, but still a 3% gain after losing almost 10% in yesterday's trade. So as Scarlett mentioned, those names, those companies that have large manufacturing operations over in Vietnam, including Nike, including Lululemon, soaring after the president said that he had a really good call with that country's leaders. So that certainly stand out. And then I got to talk about the home builders because they also popped in today's trade. D.R. Horton among them, one of the top gainers in the S&P 500, finishing up with about a 4.5% gain here. And this is, of course, what's going on in the rates market, the U.S. rates markets. Falling rates, then you expect that to maybe make it cheaper for home buyers or folks who would like to be buying homes out there. So that was good for the home builders.
So many stocks in the red today. I just had to go with indexes. The KBW Bank Index follows banks, of course, down 6.6% today. In fact, banks had their biggest two-day drop going back to March of 2020. This after China escalated its trade war with the U.S. Capital One fell 8.2%, as did Bank of New York Mellon. J.P. Morgan Chase fell more than 8%. State Street down 8%. Goldman Sachs down 7.9%. Citigroup down 7.8%. Jason Goldberg over at Barclays reminded everyone that even though banks don't have direct exposure at the same level that other industries do to a global trade war, they have exposure to the industries that are affected by this. Of course, concerns about the economy, interest rate levels as well, also weighing on banks. Yeah.
Well, we should point out, too, though, there is some direct exposure there when it comes to capital markets activity,
Yes.
Tim. You saw the IPOs that were put on pause today. Klarna, Mountain, Chime, StubHub, eToro, just to name a few. Not a single sale in the corporate debt markets today or yesterday. And then you top that off, and you talk about just the general deal-making activity. There were several deals, several M&A deals that were also put on ice for right now.
Yeah, the tightening of
And those
financial
are fees
conditions
lost.
that we've seen just in such a short period of time has been pretty remarkable. Also, keep an eye on U.S. stocks or Chinese stocks that are traded here in the U.S. with the NASDAQ Golden Dragon Index down close to 9% today. This after Beijing retaliated against the tariffs with an extra 34% levy on all imports from the U.S. Shares of the Golden Dragon Index falling by close to 9% today. Still, analysts said that retaliation came sooner and stronger than expected, and it raises concerns about an escalating trade war, even at this point.
All right, let's go to the bond market, guys. Where do you go when you need safety? The bond market. But even the moves, I feel, were somewhat tame in relation to the massive sell-off that we saw within the stock market. So you got the 2-year down by about 3 basis points. You got the 10-year down by about the same. But on a weekly basis, you're just looking at 13 basis points lower for the 2-year and about 10 basis points lower for the 10-year. So it's still like a moderation of buying that we saw. Nonetheless, the 10-year around 4, dipping below 4% at one point, definitely significant. Can I honorable mention commodities for a sec? Because we had a huge sell-off in the commodity market, particularly when it comes to crude. I mean, down a whopping like 6% in a day. 5 days, oil in the U.S. is down a full 10 percentage points.
It's kind of interesting, too. I mean, I was keeping an eye on flows, and some of this, of course, only really goes through Thursday. But we talk about record inflows this week into gold ETFs. Significant inflows, at least on a relative basis, almost record level inflows into European ETFs relative to U.S. ETFs here, and actually a lot of inflows into EM, and of course a lot of outflows in the U.S. And that great note out by Michael Hartnett this morning, in his words, actually telling people that maybe you short things right now as we enter a new secular bear market. Remember, in his view, it wasn't just about tariffs; it was also about the impact of Doge, and of course about the impact of DeepSeek back in January.
Yeah, to that point, just looking at flows, one-day flows. So this would be for yesterday. The Qs and Bill, which tracks short-term treasuries, saw the most inflows, but the volumes at which they saw inflows was minimal compared to about $4.5 billion coming out of SPY, which is the trader vehicle for the S&P 500.
You know, 2 things top of mind. We talked with our Gina Martin Adams. My concern is if the U.S., you know, if this trade war stays around for a long time and it becomes a recession here in the United States, what happens in the U.S., it could ultimately, you know, we're going to impact the whole world, right? If we see a global trade war, it's not going to be good for the global economy. It's something we talked about with Gina Martin Adams. The other thing is everybody says the caveat, what if President Trump changes his mind next week, in a month, or what have you? How long these tariffs last really determine what happens from here.
Well, walking it forward, though, too, have we seen capitulation, guys, when we talk about how many decliners are there versus advancing stocks within the S&P, and then that pickup in cross-asset volatility and the pickup in the VIX? Are we finally clearing some positioning out, which would stabilize the equity market?
I don't know. I mean, we spoke to some folks earlier in the session today, early in our program, who said 4450 is what he expects on the S&P 500. So he sees further room to move lower.
All I can tell you is I'm ready for my pizza and wine, everybody. All right, that is a wrap. Have a good weekend. I don't know. Have you looked at your 401? I've looked at my 401k.
I will say, interesting day for Scarlett to come back from vacation.
All right, guys, have a good and safe weekend. Be sure to check out the surveillance special on Sunday. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place on Monday.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is a Bloomberg Business Week. Worth going over these numbers one more time, because I think it's fair to say the biggest sell-off going back to March of 2020 for the S&P 500, we can go ahead and call that a historic day. The S&P 500 falling 5.97% in a single day, the worst day in more than 5 years. The NASDAQ falling 5.8%. Officially, NASDAQ 100 now in a bear market.
Yeah, and I think what's interesting, we talked with Peter Berezin earlier of BCA Research, you know, who's got a very negative forecast for the S&P by year end, 4450, and his point was what's different from that COVID sell-off is that it was followed by Fed rate cuts and a lot of stimulus. So a lot of money pumped into the economy, and that is why he is saying, you know, the possibility of recession and why the outlook for stocks in the U.S. is not so great.
But yeah, and look what happened last time we had all that stimulus.
Well, right, we rallied off of it.
We did, but we got an inflationary environment for years to come.
Correct, but we definitely got a market bounce. Exactly. And we've been kind of working our way out of it. We've got a great voice that we want to get to. Liz McCormick is Chief Correspondent for Global Macro Markets, joining us from New Jersey. Liz, you've had so much reporting out there. I'm trying to figure out where we want to start, because you know what was interesting is I thought what Alex mentioned about what we saw in the bond market this week versus what we saw in the equity markets doesn't match up. Much more a negative tone in the equity trade. What is the Treasury trade telling you today after the week that was?
Yeah, and I was listening to you guys talk, and I heard Alex's points. I think in some ways, like if we look back, remember some days, intradays, it was like across the board. Each tenor and treasuries was down over 10 basis points. So we had some decent moves. We've kind of come back today. I'll talk a little bit about that later. But I think I was going to say bigger picture. If we step back, remember how far we've come. That the 2-year note yield is down almost a percentage point from the highs of earlier this year. 10-year note, it seemed like couldn't crack 4%, and it did. Now it's just trading quite hovering near there. So I think the Treasury market has done it. I mean, if you look at the IN page for us, our indices. The U.S. Treasury index is up about, I think the last I looked as of yesterday, about 3% for the year. So it's kind of been doing its job. You have seen that flight to haven. It's just the superlatives, like you say, in these other markets, from stocks to what worries me, even though my main area is sovereign, what I really watch is credit risk, right? And like you mentioned, we have these CDS widening, junk bond spreads widening, all these other things, people pulling deals. That's where I worry that, like you're saying, it depends if President Trump really ends up negotiating. But certain things you can't put the genie back in the bottle, right? If credit risk keeps going, and then we get this hidden leverage, which is always like something that's lurking. If people start, losing on positions and leverage, things start cracking. You can't fix it that quick, right? So that's what I worry about. Yeah.
I am looking at the IN page. U.S. aggregate up 3.6%. Is that what you're talking about? Yeah. I mean.
Yeah, exactly. Yeah.
Wait, say the page one more time for the Bloomberg subscribers.
Oh, I love that page. IN Go, easy in, right? That's all our indices. And you can look at all the fixed income indices. And so that's at least good that, if you're in a portfolio, you're talking about your retirement, 60-40, at least the bond side has worked for you. So you have some gains where you're getting crushed in your stocks. But yeah, I think, today, let's talk a little bit, maybe you have a lot, but about Chairman Powell. Like, he was very calm, and I feel like led with inflation, right? Yes, the tariffs are bigger than we thought. Of course, he mentioned it would hurt growth, but he seemed very clear that they don't want inflation expectations, public inflation fears to kind of take off. So he was very we have time to wait. So
he seemed very calm. I mean, Jay Powell was a very measured, mild-mannered person. I don't know him personally, but it seems like.
Oh, come on. You can share. That Dead concert you went to together?
I actually want to go for a bike ride with him, but that's neither here nor there. I think that would be a fun thing to do. But it does make me ask you, Liz, given his comments earlier today, did it seem to you that he was really calm about saying, hey, we've got time here?
Yeah, I want to say that I had a feeling, and people I think thought I was crazy, that even though the market, let's say the swaps market pricing and Fed cuts was really kind of getting over its skis, pricing in almost 5 cuts this year. I said, let's be wary that Chairman Powell, because that's his job. He has a dual mandate, right? And like you're talking about, everyone's cutting their their growth forecast. Simultaneously, they're lifting their PCE forecast, right? So this is, I hate to use that word, this is a stagflationary thing. So, and the Fed kind of never got, I don't want to fault them, but inflation hasn't sustainably got to their 2% target after the pandemic. They did a lot of great stuff, and it's down. So I think he's very weary, because he knows if you let that inflation genie out of the bottle, that's the worst problem for them. So I think that's why he was very measured and calm. And we will see. We had yesterday we had some economists saying no cuts, some saying 5 cuts. It's all over the place. So I think they're waiting to see. But Powell was very calm.
Well, one thing I want to ask you, too, is you always check in with all the trading desks, the global, fixed income bond trading desks around the world. Were people kind of freaking out? Were people saying, yeah, we've got a global recession coming? I mean, it's all interconnected, right? It's not just, even if we are pulling back on global trade, I mean, what happens here is going to matter what happens in other countries. I mean, it's important. So I'm just curious, what was the tone, Liz, that you were hearing?
Yeah, I would say overall for investors, I mean, again, it's a bunch of superlatives, but this, even though we had the stories about Mar-a-Lago and we thought, think Trump will go out of the box, I do think, Carol, many investors feel like this on trade is a seismic change, right? He's trying to reorder everything, right? And he said, Trump has said he's willing to take some pain, but they didn't realize, I think everyone keeps saying to me, Liz, we knew there would be, quote unquote, reciprocal. but not by this math that they pulled off, right? You know, that was much higher than they thought. So I think that's what everyone said. It's worse than I thought. I will say Dan Iverson of PIMCO was kind enough to talk to me today, and he's, you know, they've been warning for a while that, hey, this tariff is a risk and just to be cautious. And but he said that what President Trump rolled out was a little more hawkish than they even expected. So I think everyone was taken by surprise at how kind of stringent the tariffs were.
All right, so there is that. Is there also an expectation, Liz? I mean, this is a lot of this came up in a lot of our conversations today. Is that the expectation is just like we're seeing with Vietnam already, right? Lululemon rallied, Nike rallied. There were names that rallied because there is that expectation that these countries are going to come back and negotiate. Is there in the investment community the same feeling?
Yeah, I mean, I had a few say to me, you know, like hope is not a plan, even though they hope to see this. And like you said, there was the positive signs on Vietnam, although China kind of came in hard. The EU has said, and we have stories on that, that they're hoping to negotiate. So I think there is some hope that this doesn't turn out to be as bad as it seems at the moment. But then we have President Trump coming out on social media kind of saying, hey, my policies are stuck. So I think people are very kind of on Tinder hooks. You know, they're not sure.
But let's play that out for us, Liz, a little bit, because I think that is sort of the optimistic view here, that this could be an opening salvo, and we could see a situation like we got a little preview of with the Vietnam news earlier today, where we did see stocks bounce a little bit off of their lows as a result of that post from the president who said, the country is, you know, wants to take their tariffs away. If that is indeed the case, it still sets up for quite a bit of uncertainty. And we know that what executives don't like is uncertainty. They want to be able to plan where their next plant is going to go. They want to be able to plan who they're going to hire for the next year. And if these things can get implemented and then pulled on such short notice, I think that could create a challenge for these companies.
Yeah, I 100% agree that, you know, even if there's some negotiation, I don't think also, Tim, that anyone thinks that there'll be a wholesale reversal. President Trump wants a more tariff-heavy policy, right? So even if the worst of this is dialed back, it's still very different. But I think you're right. Many companies are saying, how can I put out a big investment? I don't want to sell new debt now. I'm not going to add to my hiring, all these things, because like we always say, but it's true. Uncertainty is the worst thing. And when I was trying to do the coverage right after, and we were figuring out what's going on when President Trump gave his speech on Wednesday, the quick thing from a lot of people, even after we got the full chart, is we thought we were going to get full certainty, and now we don't. You know what I mean? And I think, like, even on the negotiation, people don't know. And I want to bring in, like, maybe you've been talking about this all day too, so sorry if so, but like, let's think about, there's the tariffs and then there's the wealth effect. Like, Carol, you were joking about your retirement.
No joke. I told Carol, I wasn't joking. I told Carol, maybe this is a night when she goes and orders the pizza not to get toppings.
Exactly. I mean, it's real. You start to say, well, or somebody was going to switch jobs, maybe not, you know, at the margin. I mean, maybe this is like soft data, so to speak, but your retirement account is real, and even non-retirement. I've got young 20-some kids looking at their portfolios. So I think everyone, it feels a little less rich, and that does factor into whether you're going to buy that new thing. So again, even if slowly some of this gets negotiated down, those factors, I don't think the stock market will be jumping to each other. They're not buying all the dips now, right? You know, so I think it's a little bit of a longer process. So I hope we don't get things that break. You know, leverage comes out, the basis trade blows up, all those things that, you know, once that gets going, it creates some more kind of systemic issues.
Well, that's what I think about. What's most vulnerable right now, Liz, in this environment? Because I do think about, right, that, you know, the idea of like stopping something versus starting it up. Stopping it can be easier than getting it going again. And I think about the economy and what could be some of the lasting impacts of this tariff policy, especially as you say, this is something President Trump has been behind for a long, long time. And it doesn't feel like he's going to roll back so easily. Even if he pulls back a little bit, it's still going to be there. And I do wonder about the longer term impact on the U.S. economy here.
Yeah, and I think these hidden things are, that remember we all lived through 2019. We haven't had a repo issue like seismic now, but leverage. There's things, when people start losing money and you get margin calls on different things, then you start selling things that you can, and that stuff you don't. It's like you don't see coming all the time, right? And that creates issues. And then, like you said, even like liquidity in markets, when that starts to break down, and that's what the Fed is concerned about, market structure. But overall, remember we were like, before all this, maybe we're going to get through this with this like rare thing of no recession. Fed tightened all this way, and now they dialed back and no recession. Now let's say the worst of the Trump tariffs aren't laid out, but like you both said, that still structurally there's tariffs. Who is it? JP Morgan saying if this continues, we get a 60% odds of recession. It just seems like the recession case, even if it's not this cataclysmic near depression, people are sometimes saying globally now, that slowdown we thought we'd avoid, that economics recession we may have it, right? So that's enough to kind of keep the edge off stocks and other things.
We've already seen sentiment, consumer sentiment pulling back. We've seen business spending pulling back. So yeah, just watching all of these indicators. Liz, this was such a great deep dive. Thank you. So appreciate it. Have a great weekend. Liz McCormick, she's chief correspondent for Global Macro Markets. Highly recommend you check out all of her work on the Bloomberg Terminal and at Bloomberg.com.
It may be Friday afternoon, Carol, but we are getting some big news right now. Two redheads crossing the Bloomberg Terminal just in the last couple of minutes. One has to do with the VIX index closing at its highest level, going all the way back to April of 2020. The other one, which is causing shares of companies that make these drugs in the after hours to move lower, is that the Trump administration has dropped Biden's Medicare obesity drug coverage proposal, looking at shares of Eli Lilly dropping 2.9% post-market, ADRs of Novo Nordisk falling 3.3% in the after hours.
Yep, so it continues. And just want to remind everybody, we talked about the VIX a little bit earlier on. Another gauge that we follow, certainly a sign of fear in the markets, hitting 45.31 at the close. It was up as much, it pretty much finished at its highs of the day. So a very key level going above 40. And so that was pretty significant, as we mentioned. So VIX closing at its highest level since April of 2020. We keep going back to 2020.
Yeah. Well, our next guest argues that in any normal day, such as today, our day would have been dominated by Friday's U.S. employment report. But today, it's barely an afterthought. Indeed, that turned out to be the case. We've got with us Bloomberg News macro strategist Cameron Kreis, who joins us from Connecticut. Cameron, I know you've been busy today. We appreciate you taking the time. The title, you have many posts just today, but the one that really caught my eye is "Questions Abound as the Whiff of Crisis Gets Stronger." What is the crisis that is starting to emerge right now?
Well, you alluded to it in terms of the price action. There are just, however you sort of look at it, days like this, and yesterday, you typically only see during periods of extreme financial stress, periods like COVID, periods like the GFC. And there are a number of metrics that you can look at that sort of only tick the box when you are in periods of acute financial or economic stress.
Let's talk about some of those metrics real quick. Because as you
you just alluded to the VIX. You can look at the change in credit spreads. The level of credit spreads is still reasonably healthy, but the rate of change is obviously you've seen a very, very abrupt widening that you don't normally get in sort of just organic market conditions. There's you only get that sort of big rise in junk bond spreads or investment grade spreads when there's stress out there. If you look at the sort of a trailing ratio of the size of up days in the S&P versus the size of down days in the S&P, obviously we've had a couple of big down days over the last couple of days, but over, say, the last 2 months, the magnitude of your average down day has been very, very much larger than the magnitude of your average up day. And that spread is the sort of thing that we've only seen in the past sort of quarter century, during COVID, during the GFC and during the Eurozone sovereign crisis. So, I like to say that you can tell a lot about the market by the company that it keeps. And when you see this sort of price action through a number of different vectors that only really kind of crops up during these prior periods of acute crisis or acute stress, that kind of tells you that we're not going to go back to slow and steady anytime soon.
Yeah, and I'm just going to go through some of the superlatives again. We were doing it with our TV colleagues. S&P 500 ending the week down 9.1%, biggest decline since March of 2020. NASDAQ 100 entering a bear market after falling 21% from its record. S&P 500 plunging 6% in the worst rout since March of 2020. So we're talking about today's trade. And then you have the VIX, as we mentioned, highest level since April of 2020. And then the Bloomberg Commodity Spot Index capping 6.8% in a two-day drop. Having said that, we had a conversation, I think it was yesterday, Cameron, where people were saying, yeah, but it feels kind of orderly. Yesterday, we actually had some names, a decent amount in the S&P 500 that actually were up on the day. What is it going to take for full market capitulation? What says to you? Is it what we hear from the White House ultimately that will determine full market capitulation, at least on the equity side of things, or just overall?
Well, I think we saw a whiff of it today. As you alluded to, I think there were 95 names in the S&P that were up yesterday. Today, there were only 14. Mm-hmm. So clearly yesterday, people were trying to do some sort of rotation trade to sort of hide out in defensive names, whereas today there was a lot more just blanket selling. That having been said, as you alluded to a few minutes ago, this Vietnam stuff did engender a bit of a rally in some of the apparel and footwear companies. So I suppose you could argue that same process was in train a little bit today. But, when you only have 14 names out of 506 or however many there are, that's pretty indiscriminate selling. So, combined with some of these other metrics, I think maybe you can say we're starting to see a few babies getting chucked out with the bathwater.
Can I just throw in there small caps, peak to trough? Peak was back in late November. I think off like 25%, just slammed.
Small caps have, they've been. Am I allowed to say the redheaded stepchild of the equity market? Is that?
You just did.
Am I allowed to say that?
It's out there.
That used to be a phrase you could use. They've been sort of the poor cousin of the S&P and the NASDAQ for some time now. And, I think they're also, it's reasonable to say that they're probably more exposed to the pure domestic economy in the sense of what this tariff stuff does, as you alluded to, it increases uncertainty. When people are uncertain, they pull back on purchases. They pull back on investment, and it also represents, at its very basic level, a tax hike. Right? It's a consumption tax, and the U.S. economy is nearly 70% consumption. And if you're going to apply this sort of from above, this very substantial tax on consumption, kind of by definition, you're reducing the purchasing power of the public. Public's going to buy less. They're going to spend less. The economy is going to grow less. And small caps being particularly attuned to the fortunes of the domestic economy, not maybe having the, shall we say, the tax flexibility that some of the larger cap companies have in terms of offshoring revenues to maximize tax efficiency.
Right.
Yeah, they are a sort of a leverage play on the downside of the economy, and that's kind of what we're seeing play out.
Well, Cameron, given that we're seeing tariffs at a scale that we haven't seen in close to 100 years at this point, so for all of us,
I think it's probably fair to say that nobody alive has seen this
exactly.
before.
I was just going to say, we've never seen this in our lives before. End with a prediction for us about how this ends. Does the president keep the tariffs as they are? Does he decrease them? Does the U.S. economy adjust? Like, what do you think happens here?
I would say that I and virtually everybody else out there expect some modification. I mean, it's sort of the style of the president to go in hard and then negotiate concessions and then relax some but not all of the initial tariff announcement. We've seen that already play out vis-a-vis Canada and Mexico already this year. So I think everyone expects some sort of pullback in terms of the if you will, the global effective tariff rate. Now, will that apply to China? Not necessarily, because I think there is maybe more of a geopolitical orientation in terms of the tariffs with China. That having been said, as you've said, all of this still creates a lot of uncertainty, right?
Yeah.
So
yeah.
I think next week people are expecting that there's going to be some sort of pullback in the overall level of tariffs. The 10% blanket tariff that goes into effect on April 5th, I think people have pretty much accepted that.
Right.
So between April 5th and April 9th is really the key date. So April 5th obviously is tomorrow, so no one's going to be trading tomorrow, thankfully. So between Monday and next Wednesday is really going to be an extraordinarily tense and volatile period. There's going to be at some point an attempt to rally the market, either on a rumor or an expectation, or indeed a headline that something has been modified in a more friendly fashion. That having been said, in the longer run, a 10% tariff is still a shock, right? Anything on top of that is still a shock.
And it has an impact.
It's gonna have an impact. So I think it is going to be quite deleterious to U.S. And global growth. I think it's going to be quite deleterious to U.S. earnings, U.S. margins, the same elsewhere. So my expectation is that there's probably a bit more downside ultimately for U.S. and global equities. It's in a sense, the era of globalization was also an era of financialization, and U.S. equities were the disproportionate winner of globalization.
And I got to say, I want to leave it on that note because it's something we talked about too with our Gina Martin Adams, the idea that what happens in the United States, I mean, we're not just talking about maybe a U.S. recession, but we're talking about a global recession. And so everybody, feels the pain, and there's really no place to hide for the most part in terms of the investment environment. Hey, Cameron, thank you so much. Look forward to your reporting next week. Cameron Kreis, he's Bloomberg News macro strategist, joining us from Connecticut.
He mentioned certainty, uncertainty. It's something we're going to be talking about in just a couple of minutes. In the meantime, though, let's get on over to Charlie Pellet with an update on how the market's closed and still news happening in the after hours. Hey, Charlie.
Yes, our coverage continues. Bloomberg will keep you posted on any market developments. Do want to begin, though, with a couple of other red headlines crossing right now on the Bloomberg Professional Service. The U.S. Supreme Court is letting President Trump halt teacher grants cited as DEI. The Trump administration also is not moving forward with a highly anticipated decision on whether costly obesity drugs would be covered by Medicare. That in its annual regulatory update today. We are seeing shares of both Novo Nordisk and Eli Lilly tumbling right now. We've got Lilly down by about 0.8% in the after-hours session. Also moving lower, shares of Novo Nordisk, they are down after hours as well. Market coverage, S&P 500 plunging 6% today, and the worst rout since March of 2020. The Bloomberg Commodity Spot Index capped a 6.8% two-day drop. The VIX closing at its highest level since April of 2020. Bottom line here, steep losses for U.S. equities. S&P at the lowest in 11 months, slashing $5.4 trillion in market value in just 2 sessions. S&P down 322, down 6%. The Dow today down 5.5%. Nasdaq down 5.8%. The 10-year 3.99%, with a 2-year 3.64%. Spot gold down $78, down 2.5%. West Texas Intermediate crude down 6.4%, down at $62.54 a barrel. So what is happening? happening with markets. Megan Horniman is Chief Investment Officer at Verdance Capital Advisors, and she was a guest right here on Bloomberg Business Week Daily.
I think this is kind of a resetting of expectations. That's what we're telling our clients. We're looking at not only expectations for growth now coming down, the likelihood of a recession rising. Inflation is really still an unknown. And then you have analysts trying to wrap their head around the earnings expectations. So we're getting this complete reset of valuations, reset of earnings estimates, reset of economic growth.
Megan Horniman of Verdance Capital Advisors, interviewed moments ago right here on Bloomberg Business Week Daily. Bottom line here, stocks lower across the board. S&P today down by 6%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stanovic, live here in our Bloomberg Interactive Broker Studio on Bloomberg Business Week Daily. Do want to mention a headline, a lot actually coming here late on this Friday afternoon. The U.S. Supreme Court cleared the Education Department to withhold money for teacher training projects in 8 states, intervening for the first time to bolster President Trump's campaign to wipe out federal spending programs he opposes. 5 of the court's conservative-leaning justices to halt a trial court order that had temporarily required the Education Department to keep covering incurred expenses in the 8 suing states. The Democratic-led states went to court after the department canceled 104 of 109 grants under 2 training programs because of concerns about diversity, equity, inclusion. Should point out, Chief Justice John Roberts and the court's 3 liberal members indicated that they would have denied the government's request. So again, some late news here on this Friday. There's a lot of it.
Speaking of a lot of news, I do want to remind everybody that there is Sunday coverage, a special edition of Bloomberg Surveillance, 5 to 7 p.m. on Sunday, covering everything you need to know going into Monday's trade. Do check that out on Bloomberg TV. Well, one of the things that Carol and I heard repeatedly over the last few weeks as our guests counted down to April 2nd was that there'd finally be some certainty. We'd know what the president was thinking when it came to tariffs. In other words, executives would know what was coming so they could plan their CapEx, shore up supply chains, hiring, get on with selling things or providing services. Well, we got our answer on Wednesday, and as Bloomberg News senior economic writer Sean Donnan notes for Bloomberg's Weekend Edition in an essay, the uncertainty is not going to end. Tariffs, he writes, are just the latest symptom, but the causes are deeper and go well beyond Trump. We've got with us Catherine Bell, Bloomberg News Weekend Edition editor. She joins us here in the Bloomberg Interactive Brokers studio. We're going to touch on Sean's story in just a second, Catherine, but before we get there, I just want to get inside your head a little bit as the editor of the new Weekend Edition to hear from you about how you go into a weekend such as this, planning what the writers are going to write after a week that we saw.
Right. So the thing about the weekend is that we have been working on the stories in many cases for a long time when we get to the weekend.
Right.
And so it is a little harrowing, honestly, when so many things change at once in a week. But really, what we think part of the point of the weekend for our readers and really for ourselves as well is that you may not have a lot more time on the weekend that you do during the week, but you have more intellectual space when the Zoom meetings and the market slow down and the markets close to really step back and think about what's happening in a more expansive way and try to understand why and to think both back into history to kind of understand the context of what's happening and also to think ahead about what may happen next and to try to just take that pause to understand things a little more deeply. So in our essays and in dispatches we get from our reporters around the world, we're really trying to see what's changing in a more thematic way. So we're really happy when the pieces we've been working on for quite a while often just feel right at the moment when they come through. And also we do sometimes do a lot of shifting things around at the last minute.
That's so true. I have to feel, I can't tell you how many times like there's things that either I hold to the weekend or I look for the weekend where I can settle down and kind of get, as you say, the history or kind of more meat behind a certain situation. Having said that, you talk about uncertainty, and Sean Donnan does have a story that is part of Weekend Edition. So tell us a little bit about how he was thinking about it, especially when it is a word that comes up almost in every conversation we have and often multiple times.
Right. So he calls the global economy right now a perpetual uncertainty machine. And he, ouch. I know. And he basically says, if you're feeling uncertain, get used to it, because this is this has been brewing for a long time before Trump, and it's going to keep going. So obviously, Trump is drastically increasing the uncertainty with all of the moves that he's making, and the rest of the world is feeling that. But there are forces that have been percolating for a long time in the way that the economic order has been shifting, and also in technology with AI. And we really don't know how that's going to play out, no matter how much we try to predict it.
It's an interesting perspective, right? Because we are using it so much. But you're right. We've been talking about populism, right? The rise of populism over the last couple of years is not just something that happened overnight.
Yes, exactly. John Authors wrote a piece for us a couple of months ago, actually right after the election. And one of the things he said is, when you feel these huge economic shifts in the global order, usually they're kind of ratifying something that's been taking shape for years. And in that piece, he argued that what's happening now has been a shift that started with the financial crisis.
It's pretty remarkable because if we think about it just from the perspective of onshoring or nearshoring, and I think what the president would want to see is a return of manufacturing to the United States. We haven't found one person who says that we can actually bring manufacturing back to the U.S. What they do say is, if we do see investment by U.S. firms that traditionally have built or have manufactured in what we would refer to as developing countries, what you would see here is automation. And you'd see that those jobs that exist outside of the U.S. wouldn't exist here because we don't have the workforce and we wouldn't pay the wages that for the products that would be required to actually support workers here in the U.S. It's all about automation.
Right.
Like a fundamental shift in the way that companies do business.
I mean, you can't separate all these strands out, right? There's all of the political shifts, the economic shifts, along with technology. And what they're trying to do right now is undo many decades of very complex changes in the global economy. And that can't just, I mean, this is a very blunt instrument, but it can't just happen overnight like that. It just doesn't work that way.
I wish we had a couple glasses of wine, because this is like one of those deep things. But I do think about the global pandemic. We were like,
I can get you some wine.
Yeah,
it's Friday afternoon at 4:40.
I may hold you to that. But I do think about, this, Catherine, that the global pandemic seemed to come out of nowhere. And there we were, and shut down truly the global economy. Like, who'd have thought that could have happened a little bit more than 2 years ago? All of a sudden, artificial intelligence was something we couldn't stop talking about. And we were still we're on just the cusp. We had a Bloomberg Intelligence event this week that we participated in, and it was like, wait a minute, they're pretty upbeat. The spend is still happening, and maybe there's some changes and stuff, but everybody's moving forward on it. So amid all this uncertainty, I mean, there's a lot of uncertainty going on about how our world will be in 6 months, 12 months, 5 years.
Right. I mean, Sean talks about an uncertainty index where these three economists looked back to 1900 and they tried to quantify uncertainty. And of course, in the financial definition of uncertainty, the whole point is that you can't quantify it. You can't put a price on it like you can risk. But they do try to go back and measure uncertainty going back, well before the Great Depression. And what they find is that what's happening now is off the charts. And I think it is these kind of exponential shifts in technology, along with, generational changes in how the economy works.
So what are the ramifications here if a CEO doesn't understand what's coming, if an investor doesn't understand what's coming, if somebody can't plan for the future because there is so much uncertainty?
Right. Well, I mean, CEOs hate uncertainty. And I think, you get more conservative decisions, you get more short-term decisions, you get worse decisions, I think, some of the time.
Such a timely article. And like you said, it's something you can kind of just have a second cup of coffee or a glass of wine if it's dinner. But I really love this because I really do think we have to kind of sometimes step back and think about more broadly what's going on. Catherine, thank you so much. Weekend Edition hits when?
It's already out. It's
not
there.
Fair. It's not our weekend.
We're almost there. It's on the Bloomberg and it's at Bloomberg.com.
It is, yes.
So check it out, everybody. Catherine Bell, Weekend Edition editor, joining us here in studio.
All right, well, let's take a look at the markets to remind everybody about the carnage that we saw today. Is that fair to say, Carol?
I mean,
I don't want to.
Markets go up, markets go down, and we
Well,
know
on a day
big
like today,
reason
they went
why.
down the most since 2020.
I know.
Okay, just.
We're still up though, right? If we look at
Yeah, if you zoom out 100 years, Carol, the chart is up. No, I'm just kidding.
What is it that we heard? Who said that to us, right? That
if you go back to the Great Depression, I'm just kidding. We have to have a little bit of a sense of humor.
Wise,
Look, you type in GP on the Bloomberg terminal. It
Yeah.
takes you to the chart.
Yep.
You go back to a 1-year chart, and yeah, we're at levels last seen in May. Is that what you're trying to say?
Yeah. Okay. Yeah.
Okay.
Okay, we'll
no
see what
toppings on
happens.
that pizza tonight.
No, there will be tons of toppings. Hey, what we wanted to get into, I mean, we've talked with Amanda Mull before about kind of the Buy American movement that's been out there, has been periodically invoked since the Boston Tea Party with the goal of promoting economic nationalism and strengthening the U.S. economy. We're hearing it. We're hearing from Canadians, buy Canadian goods. We're hearing it from America, buy American.
Well, President Trump wants companies to move their production to the U.S. He wants your shoes, your shirts, your cars, your iPhones to be made in the U.S. He wants you to buy American.
Where did Jimmy Choo's built?
Did I say? I said shoes, not Jimmy Choo. I don't know where Jimmy Choo's
Is there
are
any
built.
difference, Jimmy Choo's
I
shoes?
I am out of my element.
Let's see what Amanda Mull
she
has
would
to
know
say
about
about
this.
that.
She's senior reporter at Bloomberg Business Week.
Do you
Amanda,
remember Sarah Jessica Parker in I can't even think of it. What is
Sex
it
and the
called?
City?
Sex and the City.
I've never even seen an episode
she
of that,
lost
and I knew what it was.
She lost her shoe, and she's like, she didn't say, "I lost my shoes, my shoes, my shoes."
Yes.
Amanda Mull, joining us from Brooklyn. Good to have you here. How are you?
Thanks for having me. I'm doing pretty well, all told.
Yeah, it's a little rough.
A lot going on.
There is, I wanted to get you back on our program to talk again about this Buy American movement and the history of it.
Mm-hmm.
We got to speak to you a few weeks ago about this, but that was before we heard about exactly what the tariffs would look like. You looked at a history of these Buy American movements. What did you find?
Well, Buy American is, I think, probably best understood as the sort of like marketing campaign, the public messaging campaign that goes along with protectionism in the United States. So you see it pop up here and there over the course of history. The first, what could be realistically called the Buy American movement, was before the American Revolution. It included the Boston Tea Party. It was resistance against economic domination from England. And then over the course of history, there's always sort of like an idea of Buy American out there, but you really see the campaigns kick into high gear and get a lot of sort of highly placed business support during times of major recessions, and especially during times where economic leaders, political leaders want to put tariffs in place and put really, really broad tariffs in place. So it I think is not much of a surprise that it's back again.
Did it work? Has it ever worked?
Well, it depends on what you mean by work.
Well, how do you see? I guess how do you interpret the way that President Trump wants it to work?
I think the Trump administration wants manufacturing to move back to the U.S. I don't think the Trump administration has a trade policy that would cause that in any large capacity. I don't think Buy American would work right now. But I think that the idea right now is to sort of whip support for the idea that the U.S. can reindustrialize, to whip support for the idea that this is ultimately something that will make America's economic position stronger, more stable, that will make America great again, honestly. And I think that it is really unlikely it would work in that scenario. There's some ways that I think they're looking at this that it probably will work. And one of those is that historically, the biggest support for Buy American movements comes from the leaders of really, really large American business empires. William Randolph Hearst in the 1930s was sort of like single-handedly astroturfed the idea of Buy American into the public consciousness. That was, of course, an era of really high, really broad tariffs. And he, owned more than a dozen newspapers. He had great control of mass media in the U.S., and he basically said to his employees, "We are putting this in front of people until they believe it." And you see that echo over and over again in history.
And the thing is, I love how you say, buying American or buying, is not straightforward. Delta's a U.S. airline that flies hundreds of planes made by Airbus, which is headquartered, we know, near Toulouse, France, and builds its aircraft at factories in Europe and North America. So does flying Delta constitute buying American? I mean, this is what we have been moving towards. Consultants said do it. Globalization, right? Everybody's going to benefit. It helps developed nations develop, right? And so, and enter the global economy and become consumers and advanced consumers, where then maybe more and more people benefit. So you just do wonder whether or not this idea of globalization, can you really roll it back? It feels like it's a mega pushback right now, but I don't know.
I think something that keeps coming to mind for me is that, like, in the history of industrial society, we have never seen a country reindustrialize.
Yeah.
Like how that happens is just like not clear. If it can work is just not clear. So you have this situation where, America is a consumer society. That is what our economy is based on. U.S. household consumer spending makes up nearly 70% of GDP. We have structured our economy and our society and our political landscape around being a country that consumes more than it produces. Consumes, I think, more than it feasibly could produce.
Yeah.
Because America consumes so much that we need essentially the productive power of the global population to fuel that. So you're looking at potentially a big decline in the ability to consume in the U.S., which is not good for the economy.
Yeah, it's kind of fascinating. It's also that one of the things that came up during the week is just like, where do you get the folks to make all the manufacturing? And then you've got to make sure that it's all automated and make sure that we can do it that way. Because China is even telling its kids to study manufacturing to fill the factory jobs. And same problem is here. Amanda, great stuff. So appreciate it. Amanda Mull, senior reporter at Bloomberg Business Week, joining us from Brooklyn. Check out her story on the Bloomberg.
Hey, speaking of reindustrialization, I do want to go to China because I've been eager to chat with Ben Harburg. He's not in China right now, but he spends a lot of time there. He's the founder and portfolio manager of Core Values Alpha, where he manages the CVA Great China Growth ETF. The ticker is CGRO. For the year, it's up about 5%, yet down close to 16% from its highs just about 2 weeks ago in the middle of March. The top holdings include Xiaomi, Alibaba, BYD, Tencent, and more. He joins us from Abu Dhabi, where it's close to 1 a.m. Ben, we do appreciate you staying up late for us. When we spoke to you a few months ago, you were in the U.S., you were here for the inauguration festivities around the inauguration of President Trump. You were optimistic, you were bullish. I wanted to check in with you again now that these tariffs have been announced and get your view on how you think the first couple of months have been.
Well, I don't think anything that's happened is unexpected. He talked about tariffs nonstop on the campaign trail. He promised tariffs. He threatened even higher tariffs than have been imposed. For instance, on China, he threatened 60% tariffs. It would be disingenuous to say that, this is hugely unexpected and a complete shock for anyone that's been following the situation closely. We expected there to be turbulence out the gate. They warned that there would be pain associated with the tariff regime. There would be pain in the public markets. There would be even pain in people's pocketbooks, but towards the greater good. So I think it's too early to judge.
You say that nothing has happened that caught you off guard, but it caught a lot of people in the markets off guard, given the decline that we've seen just in the last 2 days. The market wasn't prepared for this.
That's right. But again, I think there's just historically been this kind of hesitation to take Trump at his word, and kind of just an assumption that it will be a kind of a veiled threat and a negotiating tactic to then be used at a later date. And I think the simple reality is that people didn't fully listen to or appreciate the rhetoric on the campaign trail and buy into it. And that's why the markets have been so shocked over the last 2 days.
China's fighting back tough, right? Imposing their own. Is this going to be an all-out trade war between the U.S. and China, U.S. and everyone? I mean, I know we don't know exactly how it's going to land, but the president has been pretty clear about liking tariffs and what he wants to do in terms of bringing manufacturing and factories and investments back to the United States.
I do think it will be a tit for tat for a while, but clearly this is part of a negotiating tactic to provide leverage towards a settlement and a negotiated settlement with the Chinese on the trade imbalances and where manufacturing takes place. I think it's really important when we kind of talk about reindustrialization. I heard some of your guests speaking about it before, and this kind of rhetoric that America can never reindustrialize or no economy has. We have to think of it differently. This is thoughtful, enlightened reindustrialization. There are certainly many parts of the supply chain and many product we can never realistically bring home, and it would be hugely, unenlightened to think so. But a lot can be, and some should be, and some must be. There are kind of buckets that we have to establish of things that should come home for national security reasons.
Like what?
Things that could be so some of these critical supply chains around, say, pharmaceuticals. China has threatened to use to kind of pull and use drug precursor supply chains as a way of putting leverage back on us. Things like critical minerals. Things where we simply have outsourced things that are too essential to our national security to not have them at least be in a kind of a friend-shore environment and hopefully in an onshore environment.
So in terms of investing opportunities, how do you play it, or do you kind of ride this out at this point and wait for the dust to settle? I'm just curious what you are thinking. You've got, a greater China growth ETF. It's been a global sell-off. It's not just the United States. So I'm just curious, what's your advice to investors at this point?
You don't sell today. I mean, you recognize, and you saw even the news trickling out that, already countries are coming forward to negotiate. Vietnam, who's a critical kind of supply chain component where a lot of the Chinese manufacturing fled after, kind of tariffs on China have gone. Those negotiations are opening up. Mexico and Canada are underway. So I would not sell today. If you could buy in and you were holding cash, I'm sure Warren Buffett's having a good time right now. But my recommendation is to sit tight and let these negotiations begin. And I think we know that this is a president who's highly transactional, who doesn't want to see the market in the red for any kind of a prolonged basis, and is therefore going to take actions vis-a-vis these trading relationships to improve these relationships improve the stock market, while also being very cautious of these critical areas that, again, have to be reshored or onshored.
I just want to end very briefly with the view that you have. Core Values has this America First approach, but you also have this China ETF. How does that work? Help me understand. It seems like that's in tension or in conflict.
So what we recognized with China was there were a lot of people shying away from the market for non-fundamental reasons. And so our view was to take a lens and look at Chinese investment opportunities through a lens of whether the companies that were in that basket were contravening American national security or American values. And so we filtered out names using former government officials to kind of eliminate those and essentially enable people to access the alpha of the Chinese market without feeling they were contravening American values. In tandem, as I mentioned before, we're launching other products that are around reshoring and reindustrialization with the U.S. So it's kind of a both sides of the equation opportunity, but the intention was to allow people to access China without feeling like they were contravening American national security.
Hey, Ben, thanks for joining us so late. Appreciate it. Though it looks like you're awake. You're like not, in your pajamas or anything. So
are you being driven around? We just want to know.
I am.
I knew it.
Okay, we don't have time. Next time you come on with us, we got to get the details of what you're doing up so late. But we appreciate you taking the time. Ben Harburg of Core Values Alpha joining us from Abu Dhabi.
Let's take a look at some stocks on the move today. A big day for markets. Bloomberg News cross-asset reporter Denitsa Sukova right here in studio. Tesla.
Let's start with Tesla. It's hard to find any green on the screen, but Tesla was down 10% today and down 40% year to date. Overall, we're in bear market for the Nasdaq 100. The Magnificent Seven is suffering, but Tesla is having a particularly hard day. First, we started with a downgrade from JP Morgan saying that the report we had about deliveries is confirming the unprecedented brand damage that Wall Street feared, and that is in fact happening. We had later on, we had reports about one of the few executives that are promoting the products along Elon Musk is leaving the company. He has been there for almost 13 years. So we have the tariffs. Obviously, in the beginning, Tesla was a winner from the tariffs, but now that narrative is emerging that they're not, because obviously a lot of the auto parts are not coming from the U.S. So that here where the tariffs come.
Okay, speaking of tariffs, 30 seconds on Nike.
Yeah, Nike was one of the biggest losers of the day until we heard that President Trump is negotiating with Vietnam. Now the stock closed 3% higher. This is no big relief. If we zoom out, it's down 24% year to date. We had the earnings report that was really not as strong. We have that big comeback. We have a lot of potential. Targeting women and all that, but the tariffs are really weighing on the stock despite the small relief today from the Vietnam news.
Just 2 names, but we could do so many. 489 names in the S&P 500 lower today, so there were a lot out there, 14 higher. Bloomberg News cross-asset reporter Denitsa Sukova, thank you so much. That's going to do it for us. Big week. Thanks to our team. Do not go anywhere. Balance of Power is next.
Politics to the world of business. This is Balance of Power.